The Art of Value Investing: How the World's Best Investors Beat the Market. Written by John Hines and Whitney Tilson. Read by Walter Dixon. Introduction. When we launched the newsletter Value Investor Insight in early 2005, our motivation was not to tout the 10 best stocks to buy now, or peddle a proprietary system that would triple your money in 6 months. Primarily through 2 in-depth interviews with highly successful money managers, our goals for each issue have been to deliver not only timely investment ideas, but also timeless wisdom about the craft of investing. To that end, our Value Investor Insight interviews explore the full spectrum of stock investing. From the definition of an underlying philosophy to the identification of potential ideas, the research and analytical process, the discipline around buying and selling, all aspects of portfolio management, and maybe the most important, keeping emotion and common behavioral biases from ruining the best efforts of all of the above. As befits the title of our newsletter, we're unrestrained proponents of the core value investing philosophy first espoused by Benjamin Graham and then embellished and popularized by Warren Buffett. Value investing means different things to different people, more on that later, but value investors' core belief is that equity markets regularly offer, for a variety of different but predictable reasons, opportunities to buy stakes in companies at significant discounts to conservative estimates of what those businesses are actually worth. If you can consistently get the value of the underlying business right, pay deep discounts to those values in buying the company's stocks, and maintain your conviction and discipline while conventional wisdom regularly goes against you, you can beat the market. While the core precepts of value investing strike us as eminently sound, age and experience have also made it equally clear that, like fingerprints, no 2 value investing strategies are exactly alike. So many elements make up a given strategy and its execution that, when combined with inevitable differences in judgment, it's perfectly normal for equally talented and accomplished investors to assess the landscape of investment opportunities or a specific idea and come to diametrically opposed conclusions. That's what makes investing and making judgments about investors so difficult and endlessly fascinating. As encouraging as it may be that there are a multitude of paths to investment success, that in no way argues for trying to pursue several at the same time. The best investors, in our experience, can articulate in a clear and focused way what they're looking for, why they're looking for it, and where they're trying to find it. They have a well-defined and consistently applied process for research and analysis. They follow specific disciplines for buying, for selling, for diversification, and for managing risk. They are well versed in the behavioral traps investors can fall into and take concrete steps to avoid them. Obvious as that all should be, we're constantly surprised by the number of professional money managers who can't credibly argue why and how they expect to outperform. Our goal with the Art of Value Investing is to offer a comprehensive set of answers to the questions every equity money manager should have thought through clearly before holding himself or herself out as a worthy steward of other people's money. Because there is not just one credible answer to each of these questions, we've provided a full range of potential answers and the justifications for each. What market inefficiencies will I try to exploit? How will I generate ideas? What will be my geographic focus? What analytical edge will I hope to have? What valuation methodologies will I use? What time horizon will I typically employ? How many stocks will I own? How specifically will I decide to buy or sell? Will I hedge, and how? How will I keep my emotions from getting the best of me? We've delegated the task of providing answers to such questions to the experts, the market-beating money managers who have graced the pages of Value Investor Insight. Hedge fund superstars such as Julian Robertson, Seth Klarman, Lee Cooperman, David Einhorn, Bill Ackman, and Joel Greenblatt. Mutual fund luminaries including Marty Whitman, Mason Hawkins, Jean-Marie Evelard, Bill Nigan, and Bruce Berkowitz. Lower profile but no less accomplished money managers such as Maverick Capital's Lee Ainsley, Highfield Capital's John Jacobson, Ralph Whitworth of Relational Investors, and Jeffrey Ubben of Value Act Capital. We hope to provide useful context and organization to the discussion, but we leave it to these superior investors and dozens more like them to describe how they practice their craft and why. We can't imagine more credible sources of information and insight. We should emphasize that our goal is not to present a single answer to any strategic question an investor faces. Any investor's given performance is a function of thousands of individual decisions about the strategy he or she employs and how it's executed over time. One investor may invest only in large-cap stocks, while another may never touch them. One may consider spending time with management to be the most important component of research, while another may find it a complete waste of time. One may specialize in energy stocks, while another avoids them like the plague. What we will do is present the conclusions that a set of uniquely qualified investors have reached on a wide variety of subjects, as well as their explanations for why they've chosen the strategy and methods they have. While their conclusions will frequently differ, we hope the diversity of opinion helps inform the decisions you ultimately will have to make as an investor. Who should listen to The Art of Value Investing? Our aspiration is for it to be as vital a resource for the just starting out investor as for the sophisticated professional one. The former are provided a comprehensive guidebook for defining a sound investment strategy from A to Z. The latter are provided challenges to all aspects of their existing practice and provocations to potential improvements. We also want the audiobook to be a must-listen for any investor, institutional or individual, charged with choosing the best managers for the money they are allocating to equities. Choosing the right managers for you consists of knowing the right questions to ask, as well as the answers worthy of your respect and attention, both of which we aim to deliver. Our organizing principle for the content roughly matches the chronological progression one would follow in defining and executing an investment strategy. In Chapter 1, we explore the core principles investors rely on to guide their strategies. While those principles for all the investors we hear from fall under the value investing umbrella, that umbrella covers a diverse spectrum of thought and opinion. In the section Field of Play, the best investors in the business describe how they define their circle of competence, the types of situations and inefficiencies on which they look to capitalize, and how they generate ideas. In the section Building the Case, we examine how top investors go about their research, where they focus their analytical efforts, how they value companies, and the disciplines they follow in deciding what to buy and when. While most of the literature on stock investing stops at getting to the buy decision, the final two sections of The Art of Value Investing address equally important contributors to investment success. The section titled Active Management describes best practices in all aspects of portfolio management, including position sizing, diversification, responding to changing circumstances, and the decision to sell. In the section of Sound Mind, we learn how superior managers learn from mistakes, what motivates them, and how they face the many threats to rational thinking that investing serves up. All of the quotes used have appeared in the pages of Value Investor Insight, with the vast majority coming from first-person interviews we have conducted over the past 8 years. In a small number of cases, most prominently the timeless wisdom from the Baupost Group's Seth Klarman and Oaktree Capital Management's Howard Marks, certain quotes have come from investor communications that were either publicly available or for which we were granted permission to use. In all cases, we offer our sincere thanks to everyone we've interviewed, whose generosity in sharing their experience and insights is truly an inspiration. The quest for knowledge is a never-ending process for investors and is what helps separate the best from the rest of the pack. To contribute in even a modest way to that learning process is truly an honor. John Hines, Whitney Tilson. Chapter 1. All sensible investing is value investing. A walk down any supermarket aisle makes it clear we live in a world of increasing product specialization. To break into a new market or grab more of an existing one, companies launch a dizzying array of new products in ever more specific categories. Want your soda with more caffeine or less? You've got it. More sugar, less sugar, 6 ounces, 10 ounces, 20 ounces, whatever you like. This trend has not been lost on marketers of investment vehicles. Specialized mutual funds and exchange-traded funds exist for almost every imaginable combination of manager style, geographic reach, industry sector, and company market capitalization size. If you're looking for a mid-cap growth fund based on the commodity sector in so-called BRIC countries, Brazil, Russia, India, and China, you're likely to find it. We understand the marketing reality of specialization, but we argue that the most important factor in judging an investor's prospective gains or losses is his or her underlying philosophy. As you might guess from the fact that we co-founded a newsletter called Value Investor Insight, we agree 100% with Berkshire Hathaway's Vice Chairman Charlie Munger, who simply says that all sensible investing is value investing. But what exactly does it mean to be a value investor? At its most basic level, it means seeking out stocks that you believe are worth considerably more than you have to pay for them. But all investors try to do that. Value investing, to us, is both a mindset as well as a rigorous discipline, the fundamental characteristics of which we've distilled down to a baker's dozen. Value investors typically focus on intrinsic value, what a company is really worth, buying when convinced there is a substantial margin of safety between the company's share price and its intrinsic value, and selling when the margin of safety is gone. This means not trying to guess where the herd will send the stock price next. Have a clearly defined sense of where they'll prospect for ideas, based on their competence and the perceived opportunity set, rather than artificial style box limitations. pride themselves on conducting in-depth, proprietary, and fundamental research and analysis rather than relying on tips or paying attention to vacuous minute-to-minute cable news-style analysis. Spend far more time analyzing and understanding microfactors such as a company's competitive advantages and its growth prospects, instead of trying to make macro calls on things like interest rates, oil prices, and the economy. Understand and profit from the concept that business cycles and company performance often revert to the mean, rather than assuming that the immediate past best informs the indefinite future. Act only when able to draw conclusions at variance to conventional wisdom, resulting in buying stocks that are out of favor rather than popular. Conduct their analysis and invest with a multi-year time horizon rather than focusing on the month or quarter ahead. Consider truly great investment ideas to be rare, often resulting in portfolios with fewer but larger positions than is the norm. Understand that beating the market requires assembling a portfolio that looks quite different from the market, not one that hides behind the safety of closet indexing. Focus on avoiding permanent losses rather than minimizing the risk of stock price volatility. Focus on absolute returns, not on relative performance versus a benchmark. Consider stock investing to be a marathon, with winners and losers among its practitioners best identified over periods of several years, not months. Admit their mistakes and actively seek to learn from them, rather than taking credit only for successes and attributing failures to bad luck. What it means to be a value investor. Elaborating in detail on all aspects of the bare-bones list just mentioned is essentially what this audiobook is about. We begin by turning to the uniquely successful investors we've profiled over the years as co-editors of Value Investor Insight to examine what they consider to be the key components of value investing philosophy, from general fundamental principles to the overarching mindset needed to make it work. Our entire process is rooted in Ben Graham's simple philosophical framework for investing. He believed there were two values for every stock, the first being the current market price, and the second what the share would be worth if the entire company were acquired by a knowledgeable buyer, or if the assets were liquidated, the liabilities paid off, and the proceeds paid back to stockholders. He called that the intrinsic value, and argued that the time to buy was when there was a large spread between the current price and that value, and that the time to sell was when that spread was narrow. Over time, we've developed different ways of applying that, by valuing income streams rather than just assets, by calculating private market values, by investing internationally. But the essence of what we do has remained consistent. Our work every day is essentially directed at valuing what businesses are worth. Will Brown, Tweedy, Brown Company. At the heart of being a value investor is having a contrarian bent. Beyond that, though, there are many different flavors of value investing. Tweedy Brown is a great deep value investment firm. Chuck Royce at Royce Funds is a wonderful GARP, growth at a reasonable price, practitioner. He's focused on value, but definitely doesn't like to own bad companies. Mason Hawkins at Southeastern Asset Management and Marty Whitman of Third Avenue are oriented towards stocks trading at significant discounts to net asset value. Bill Miller is probably best described as an all-out contrarian. The fact that all these people have been successful proves that there's no single way to do it. What the market offers up as opportunity is constantly changing, so being able to deploy a variety of strategies as the situation warrants allows us great flexibility to go almost anywhere and never get shut out of the market. That's important because our investors don't ask us to move in and out of cash depending on how overvalued or undervalued we think the market is. And frankly, having an eclectic view makes investing a lot more interesting. Preston Athey, T. Rowe Price. We found that to earn repeatable, excellent returns over time with reasonable risk exposure requires being able to assign something approximating a fair value to a business, making conservative estimates. Then it's a question of looking at the price. If price is significantly below that fair value, you're likely to have a good outcome by investing in it. If the price is significantly above that fair value, you can make good money by shorting it. Zeke Ashton, Centaur Capital. There's nothing particularly earth-shattering about what we try to do. We believe the market often misprices stocks due to neglect, emotion, misinterpretation, or myopia, so our value added comes from bottom-up stock selection. We're trying to buy at low prices relative to our current estimate of intrinsic value, and we want to believe that intrinsic value will grow. Steve Morrow, New South Capital. When I got much more interested in individual securities analysis in the early 1990s, I read as widely as I could, and a light bulb just switched on when I read everything Marty Whitman wrote. I was thinking it was critical to understand the ins and outs of how the stock market really worked, but his basic message was to ignore the market, which was just the bazaar through which you had to make trades. He was all about valuing what a company was worth, independent of what the market was saying it was worth at the time, and buying when the market was giving you a big discount and selling when it was paying you a premium. As obvious as that sounds, it was very liberating to come across such a straightforward approach. Using whatever analytical tools I want, whether it's valuing net assets, calculating private market values, or discounting future cash flows, I can arrive at a clear estimate of what a company is actually worth. From there, the actual buying and selling decisions aren't that hard. Jim Rommel, Rommel Asset Management. I've heard it said many times that value investing is not as much about doing smart things as it is about not doing dumb things. Avoiding mistakes, resisting market fads, and focusing on allocating capital into ideas that are highly likely to produce satisfactory returns and that offer a margin of safety against permanent capital loss. These are the dominant themes of the value investing approach. Contrary to how it sounds, these elements don't make value investing easier than other approaches. In fact, cultivating the discipline to avoid unproductive decisions, refining the craft of valuing businesses and assessing risk, and developing the emotional and mental equilibrium required to think independently in a field in which there is tremendous pressure to conform, requires constant diligence and effort. Zeke Ashton, Centaur Capital. Long-term oriented value investors have greater scope to produce superior risk-adjusted returns when the seas are rocky. The valid response when there's chop is to focus on the end destination, what value investors call intrinsic value, and not worry about whether the next wave is going to push the boat up or down. If you don't invest with a very clear notion of underlying value, how do you do it? Nothing else makes sense. Your ability to maintain focus on the long term comes from experience. You go through a couple cycles where everybody else is screaming at you not to catch a falling knife, and then, when you do and make some money, it does wonders for you and for your ability to do it next time. Howard Marks, Oaktree Capital. We make no heroic assumptions in our analysis, hoping instead that by compounding multiple conservative assumptions, we will create such a substantial margin for safety that a lot can go wrong without impairing our capital much or even at all. We never invest just to invest and don't bet blindly on mean reversion or on historical relationships holding up. Our settings are permanently turned to risk off. Seth Klarman, The Baupost Group. In traditional value ideas, we're looking for a large discount to our estimate of value based on a company's normal earnings power, where normal means that general business activity is not too hot and not too cold. These tend to be more average quality businesses, which can get very cheap in the down part of a cycle or when dealing with a self-inflicted problem. The priority in these ideas is on margin of safety, which we look at in two primary ways. The first is by making sure the potential downside is a small fraction of the upside. That means we avoid stocks that are cheap on an equity-to-value basis, primarily because there's a mountain of debt. The second important way to have a margin of safety is to have more than one way to win, through earnings growth, multiple expansion, or free options in the business. Lee Etzel, Pennant Capital. Whenever Ben Graham was asked what he thought would happen to the economy or to company X's or Y's profits, he always used to deadpan, "The future is uncertain." That's precisely why there's a need for a margin of safety in investing, which is more relevant today than ever. Jean-Marie Evillard, First Eagle Funds. People should be highly skeptical of anyone's, including their own, ability to predict the future, and instead pursue strategies that can survive whatever may occur. Nassim Taleb advises us to be anti-fragile, that is, to embrace those elements that benefit from volatility, variability, and stress and disorder. This is exactly what we strive to do. Seth Klarman, The Baupost Group. The person with the highest probability of outperforming over time is the one who knows how to value companies and buys at a significant discount from that. I've heard for 45 years why all these other things have become more important. You know what? It's all crap. Robert Olstein, Olstein Capital Management. Much of what we do is focused on the concept of mean reversion. For a wide variety of inputs, such as purchase-to-earnings ratios, profit margins, sales growth, and dividend yields, we assume everything will end up in 7 years at normal. There's obviously judgment involved in defining what's normal, but we're pretty faithful historians who are also trying to use our brains and trying desperately not to lose money. For a long time we used 10-year forecasts, but have concluded through research that 7 years is closer to the average time it takes for a financial series to mean revert. Jeremy Grantham, GMO. Price is perhaps the single most important criterion in sound investment decision-making. Every security or asset is a buy at one price, a hold at a higher price, and a sell at some still higher price. Yet most investors in all asset classes love simplicity, rosy outlooks, and the prospect of smooth sailing. They prefer what is performing well to what has recently lagged, often regardless of price. They prefer full buildings and trophy properties to fixer-uppers that need to be filled, even though empty or unloved buildings may be the far more compelling and even safer investments. Because investors are not usually penalized for adhering to conventional practices, doing so is the less professionally risky strategy, even though it virtually guarantees against superior performance. Seth Klarman, The Baupost Group. If I had to identify a single key to consistently successful investing, I'd say it's cheapness. Buying at low prices relative to intrinsic value, rigorously and conservatively derived, holds the key to earning dependably high returns, limiting risk and minimizing losses. It's not the only thing that matters, obviously, but it's something for which there is no substitute. Without doing the above, investing moves closer to speculating and much less dependable activity. Howard Marks, Oaktree Capital. When you look back as far as 80 years for which we have data, rather than moving about without rhyme or reason, the stock market methodically rewards certain investment strategies while punishing others. There's no question the value-based strategies that work over long periods of time don't work all the time, but history shows that after what turn out to be relatively brief periods when other things seem to be all that matter, the market reasserts its preference for value, often with ferocity. My basic premise is that, given all that, investors can do much better than the market if they consistently use time-tested strategies that are based on sensible, rational, value-based methods for selecting stocks. James O'Shaughnessy, O'Shaughnessy Asset Management. Warren Buffett has made the point many times that being contrarian really isn't the full answer. It's having conviction in your own opinion and filtering out the noise. If the market happens to be right, being a contrarian for the sake of being a contrarian isn't a very good strategy. You have to have the discipline to stick to the situations where you have an edge and sit out the rest of them. John Jacobson, Highfields Capital. There isn't really a strong value investing culture in Europe, at least that operates the way we do. Most of the big institutions here define value in terms of high dividend yields and low P/E multiples on reported earnings. That's why so many of them did poorly in 2008, because they own too many stocks and cyclical companies. The majority of European hedge funds are traders who care little about valuation, but are investing based on short-term news or momentum. Some are very good at it, but that's not at all what we do. We tell our investors that while they're betting on our skill in identifying corporate assets to invest in the end, they own high-quality assets. That's very different than investing in a trading hedge fund, where you're investing in the trading skill of the portfolio manager. If I have a bad day, that's not going to hurt the future prospects of the companies I own. If a trader has a bad day, it can be a disaster. Richard Vogel, Alitas Capital. In a rising market, everyone makes money, and value philosophy is unnecessary. But because there is no certain way to predict what the market will do, one must follow a value philosophy at all times. By controlling risk and limiting loss through extensive fundamental analysis, strict discipline, and endless patience, value investors can expect good results with limited downside. You may not get rich quick, but you will keep what you have, and if the future of value investing resembles its past, you are likely to get rich slowly. As investment strategies go, this is the most that any reasonable investor can hope for. Seth Klarman, The Baupost Group. Do those things as an analyst that you know you can do well, and only those things. If you can beat the market by charts, by astrology, or by some rare and valuable gift of your own, then that's the row you should hoe. If you're good at picking the stocks most likely to succeed in the next 12 months, base your work on the endeavor. If you can foretell the next important development in the economy or in the technology or in consumers' preferences and gauge its consequences for various equity values, then concentrate on that particular activity. But in each case you must prove to yourself by honest, no bluffing self-examination and by continuous testing of performance that you have what it takes to produce worthwhile results. If you believe, as I have always believed, that the value approach is inherently sound, workable, and profitable, then devote yourself to that principle. Stick to it and don't be led astray by Wall Street's fashions, its illusions, and its constant chase after the fast dollar. Let me emphasize that it does not take a genius or even a superior talent to be successful as a value analyst. What it needs is, first, reasonable good intelligence, second, sound principles of operation, third, and most important, firmness of character. Benjamin Graham, Common Sense Investing. Consultants in the investment world work so hard to pigeonhole investors that I think even the word value is misconstrued to just mean low multiples of book value or earnings. Even Ben Graham early on talked about how growth is of great value. It's just riskier and more difficult to quantify. I'm always amazed that someone would say they weren't a value investor. I wouldn't admit it even if I wasn't. It just seems silly to think about investing any other way. Thomas Grainer, Markel Corp. Does quality matter? No less an authority than Warren Buffett has described his evolution as a value investor from being more interested early on in cigar butt types of companies, distinguished by little more than how inexpensive their stocks were relative to their tangible assets, to an emphasis on less cheap but higher quality businesses with a sustainable ability to compound shareholder value over long periods of time. The relative importance one places on business quality remains a central element of just about any value investing approach. I started out in 1974 with a Ben Graham value strategy, which suited my personality. For 8 years the market did nothing, but it was a great time for stock pickers and value investing, so things went very well. Around 1982 it hit me that there were a lot of lousy stocks in my portfolio, and I started wondering why. Well, it sounds like an obvious conclusion now. The common denominator of the losers was that they were in lousy businesses. I realized I should be more of a business analyst than a stock analyst, meaning that to create value as an investor, I had to better understand how companies themselves created value. I moved more away from classical stock metrics of P&E and book value to business metrics of return on capital and cash flows. Andrew Pallara, RS Investments. Value to me often derives from competitively strong companies in structurally attractive industries supported by secular growth. In financial terms, it's easy to describe a high-quality business. They generate high returns on unlevered capital and high returns on equity on an after-tax basis. They produce free cash flow or have attractive enough reinvestment opportunities to invest cash flow at high returns. Great businesses are worth more, so I would rather own that type of company at a reasonable price than a mediocre company at a really cheap price. But I've also learned the hard way never to disregard valuation. You can easily overpay for even the best business. Morris Mark, Mark Asset Management. As a value investor, I was initially almost exclusively focused on companies with good balance sheets, selling at low valuation multiples. There's nothing inherently wrong with that, but I've learned from experience that when cheapness blinds you to not-so-hot business or poor management, it's a recipe for disaster. We still only buy bargains, but we pay a lot more attention to things like whether the company's returns on capital are as good as they should be, and at how adept and disciplined management is at allocating cash flow. When returns are inadequate or capital is allocated recklessly, equity value is usually destroyed. David Harrow, Harris Associates. Our view is simply that superior long-term investment performance can be achieved when financially strong, competitively entrenched, well-managed companies are bought at prices significantly below their business value and sold when they approach that corporate worth. The quantitative piece of that is that we only want to buy when we can pay less than 60% of a conservative appraisal of a company's value, based on the present value of future free cash flows, current liquidation value, and/or comparable sales. Mason Hawkins, Southeastern Asset Management. I began as a traditional value investor in the Ben Graham mold, looking for net nets, companies trading for less than their current assets minus liabilities, discounts to book value and all of that. I would say, though, that I have graduated over time to be more focused on very good companies selling at fair prices. Prem Watsa, Fairfax Financial. I have come to the conclusion, as others have, that in general you find better investments in businesses with good economics, secular tailwinds, and sustainable competitive advantages than you do in trying to get one last puff out of proverbial cigar butts. When everything's out of favor and you can buy businesses with bright futures without having to pay for that future, that's a wonderful thing. David Winters, Wintergreen Fund. I've learned that to meet my return goals, I can't have big losers, so regardless of how cheap something is or how much potential upside there is, that means avoiding companies that can wipe out, with too much debt, unproven business models, secularly challenged end markets, and no durable competitive advantages. Zeke Ashton, Centaur Capital. What I'm looking for are steady cash flows, reinvested on owners' behalf by honest and able management. Steady cash flows come from businesses that, for one reason or another, enjoy the perception of indispensability for their products. This perception of indispensability often comes from a brand, but can also be from real barriers to competition. If you have the only quarry in town, it's hard for competitors to ship into your market because transportation costs are so high. Thomas Russo, Gardner, Russo & Gardner. For the past 30 years, we've sort of floated in style between Ben Graham and Warren Buffett. Graham's approach is static, quantitative, and focused on the balance sheet. There's no attempt to look into the future and judge the more qualitative aspects of the business. Buffett's major idea was to also look more qualitatively for those few businesses with apparently sustainable competitive advantages, where the odds were fairly high that the business would be as successful 10 years from now as it is today. In those situations, one makes money not so much from the elimination of the discount to intrinsic value, but more from the growth in that intrinsic value. When I started out in 1979, both in the U.S. and Europe, there were many Ben Graham-type stocks to uncover after the dismal stock performance of the 1970s. As we grew and markets changed, we've moved more to the Buffett approach, but not without trepidation. If one is wrong in judging a company to have a sustainable competitive advantage, the investment results can be disastrous. With the Graham approach, the very large discount to static value minimizes that risk. Overall, I'd like to believe we've learned well from both Graham and Buffett, and that we own securities that would attract each of them. Jean-Marie Eviard, First Eagle Funds. We have moved more from a pure Benjamin Graham style of value investing to one closer to Phil Fisher and Warren Buffett, in the sense that we're putting even more weight on the quality of the business. I don't know, maybe when you're younger you just care about getting things that are cheap and making money fast. But as you become old you see that buying companies with high and sustainable returns on capital at reasonable prices tends to work a little bit better. Francisco Garcia Paramas, Bestinver Asset Management. What we've tried to do is marry the Graham-Dodd type emphasis on margin of safety with a more modern version of value investing that focuses on a company's sustainable ability to generate returns on invested capital, ROIC, that exceed its cost of capital. For ROIC, we use earnings before interest and taxes divided by the sum of net working capital and property, plant and equipment, less cash. That measure consistently exceeding the cost of capital means the net asset value is likely to grow, and the business can be worth considerably more than the net value of those assets. Ari Levy, Lakeview Investment Group. Speaking broadly, probably 10% of the businesses out there are lousy, such as selling pure commodities where the marginal cost of production drives the pricing, and companies find it very hard to earn even the cost of capital over time. I may own such a company from time to time, but it's rare. At the other end of the spectrum are another maybe 10% of businesses which are of excellent quality. A perfect example would be money management firms, which, in aggregate, earn obscene returns on equity. We love to own these types of companies, but the opportunities to buy them cheaply are relatively few and far between. So, that leaves us most occupied with the other 80%, in which there's a changing roster of winners and losers. Those changes in fortunes are typically tied to cycles and how individual companies are managed, which are the types of things we believe we can analyze and judge. In a lot of our companies, just getting back to average operating performance can result in excellent investment results. Preston Athey, T. Rowe Price. We would love to own great businesses as much as the next guy, but the problem is finding them at the right price. We're perfectly happy looking for the average company, where we think there's something going on which the market hasn't recognized that can make it better than average. You're rewarded as much for that as for a good company becoming very good. We do make every effort to understand what edge the company has in facing competitive threats or maintaining pricing power. When that edge isn't clear, you have to be very careful about the valuation you assign to the earnings and cash flow stream. But business quality, in and of itself, isn't paramount to our decision to buy. Vincent Salaccia, Delafield Fund. We aren't obsessed with perfection and quality. I've made some very nice investments in companies that were going from terrible to bad or bad to fair. We're just looking for the biggest mismatch between value and price. Where those occur on the quality scale can change over time. Carlo Canal, Canal Capital. Everything doesn't have to be the next Microsoft. We may invest in a company because the market thinks it's going to fail and we don't. Lee Ainsley, Maverick Capital. When I talk about the companies I invest in, you'll be able to rattle off hundreds of bad things about them, but that's why they're cheap. The most common comment I get is, "Don't you read the paper?" Because if you read the paper, there's no way you'd buy these stocks. They're priced where they are for good reason, but I invest when I believe the conditions that are causing them to be priced that way are probably not permanent. By nature, you can't be short-term oriented with this investment philosophy. If you're going to worry about short-term volatility, you're just not going to be able to buy the cheapest stocks. With the cheapest stocks, the outlooks are uncertain. In my whole career, I have yet to find the great business with a wonderful management team, high margins, a dominant market position, and all the conditions everybody wants, at a low price. The stocks of such companies don't sell at a low price. If I find one, I'll cheer, but it hasn't happened yet. Richard Pazina, Pazina Investment Management. People often say they emphasize the quality of management or the competitive moat of a company, but the problem with some of these generalizations is that companies with those attributes are very often not attractively priced. Procter & Gamble may today be considered one of the best managed companies in the world, with some of the best brand franchises and with very low risk equity. But if the stock is not attractive at the current price, none of the rest matters. Rick Dillon, Diamond Hill Investments. I'm generally not obsessed with quality. Good assets bought at the wrong price can be terrible investments, just as lousy ones bought very cheaply can generate excellent results. That anything is attractive at a price might seem intuitively obvious, but many investors consistently ignore it. People feel better in our business when prices are going up, so you consistently see buyers come in after markets have been good, while people tend to move to the sidelines and watch when markets are bad. People are in general momentum investors, which is completely at odds with being a value investor, and which can create opportunities for those who are disciplined and patient. John Jacobson, Highfields Capital. The value of growth. A corollary issue to business quality is the emphasis value investors place on a company's ability to grow. Distinctions tend to be made in how heavily weighted growth is in the assessment of value and in the conservatism with which future estimates are made. But avowed value investors typically resist being labeled as unconcerned with growth in assessing a company's intrinsic value. Positioning value versus growth sets up a false comparison. They are not opposite ends of the spectrum. Value investing and momentum investing are at opposite ends. All else equal, after a stock price falls with no change in its estimated value, a value investor will find it more attractive. A momentum investor reacts in the opposite way. A price decline makes the stock less attractive, and vice versa. A value investor needs to be able to assess the value of many business characteristics, such as balance sheet strength, cash-generating ability, franchise durability, and so on. Growth is also one of those factors. The ability to grow organically is almost always a positive. It would be a negative only if that growth required so much investment that it had a negative present value. That almost never happens. 10 to 15 years ago, investors were paying a very high price for growth. Many stocks traded at barely double-digit P/Es, but large-cap companies that had above-average expected growth were trading at 50 times earnings and higher. At that spread, we believed growth was way too expensive, and it was an easy choice to avoid it. More recently, valuations have compressed, meaning the price of growth has sharply fallen. When we can get more growth without having to pay for it, the choice again becomes very easy. I see value investing as applying a consistent discipline to a changing marketplace. As the price investors pay for growth becomes excessive, applying our price discipline moves us away from growth. As the price for growth declines, our discipline moves us toward higher growth businesses. Bill Nigan, Harris Associates. I don't get overly concerned with how my portfolios are categorized. Our mutual fund was originally called a value fund, then it was a core fund, and now it shows up sometimes as a growth fund. Through all of that, we haven't changed anything we do since day one. The notion that growth is a creator of value is an important part of how we invest. Chuck Akre, Akre Capital Management. People often make it sound complicated, but investing is really all about estimating what something is worth and then buying it at an attractive price. Even though we have a classical value approach, analyzing stocks as an ownership stake in a business, calculating intrinsic values, requiring a margin of safety, we don't call ourselves value investors in any of our marketing or other communications. Borrowing from Warren Buffett, as we often do, we see growth and value as all part of the same equation. To separate them strikes us as kind of dumb. There should be fairly broad agreement that what constitutes value are a company's discounted future cash flows. The growth in those cash flows is obviously central to figuring that out. Rick Dillon, Diamond Hill Investments. We believe the most important contributor to the long-term investment performance of the companies we own is earnings growth, not a change in valuation. Because growth is driven by earning high returns on capital and successfully reinvesting cash flow, we tend to be very long-term investors. Our average holding period runs about 7 years in order for this virtuous process to bear fruit. Because of that orientation, we put primary emphasis on market structure, the sustainability of the business's competitive advantage, and management's track record in creating shareholder value over time. If you step back and think about the basics of what we're doing, we're interested in companies that are better than their competitors and which have shown the ability to take the cash they earn and do something smart with it. There's nothing earth-shattering about that, but to the extent you can apply it, understand the business dynamics, and not pay foolish prices for things, there's no reason you shouldn't get the attractive long-term returns we believe we and our predecessors have produced. Eric Endy, First Pacific Advisors. When I started in the business, and for a long time, my concept of value was absolute value in terms of price-to-earnings ratio. But I would say my concept of value has changed to a more relative sense of valuation, based on the expected growth rate applied against the price of the stock. Something trading at 30 times earnings that is growing at 25% per year, where I have confidence it will grow at that rate for some time, can be much cheaper than something at 7 times earnings growing at 3%. Some people call that GARP, growth at a reasonable price, investing. I'd call it value. I think that's just semantics. We've always had excellent analysts, and a good analyst is more adept at making judgments on growth. That's their job. Based on the business and the company's position on it, how fast is the company going to grow? It's pretty hard to lose if you're right on the growth rates when the growth rates are high. In that 30 times P/E company growing 25% per year, you'd be bailed out pretty quickly because in about 2.5 years the earnings will double, and the multiple on that will go to only 15 times. Julian Robertson, Tiger Management. I'm a value investor, which says I want to buy 50-cent dollars, but given my firm's predilection for serving the needs of taxable investors, I also want that dollar to tax-efficiently compound in value over long periods of time. That means the businesses I find attractive must have great capacity to reinvest, which is not all that common. Thomas Russo, Gardner, Russo & Gardner. In such a value-focused world, we need to be all the more contrarian in our views. It also requires additional research focus on unique future potential situations that might traditionally have been called growth ideas. This is just a practical response. As defined in classical Graham and Dodd terms, a bargain basement stock has a market capitalization lower than its net working capital, current assets minus current liabilities. The approximate number of companies selling at a discount to net working capital today is 0. Murray Stahl, Horizon Asset Management. In my experience, it's been more important to be involved with a powerful trend with accelerating potential returns than to get too hung up on valuation. That's not at all to say valuation doesn't matter, but there have been many times when I've been right about the trend but didn't buy a leader because it was 20% too expensive, and that turned out to be a mistake. John Burbank, Passport Capital. To me, investing success is 50% analytical ability and 50% understanding and playing off the market psychology. We are serious students of macroeconomic influences and trends, and are most interested when industry sectors that should benefit from major demographic, technological, or economic shifts are out of favor. Ralph Shive, Wasatch Advisors. If you're looking, as we are, for extraordinary returns from companies whose stocks can go up 10 times rather than 2 times, it's far more likely to happen because the company's earnings turned out to be so much better than anyone expected than because you found a temporary 50-cent dollar. John Burbank, Passport Capital. I'm looking for opportunities in which I have a differentiated view on forward earnings, preferably revenue-driven. You generally make money in 3 ways on the long side. Your estimates are higher than the streets, and the consensus moves to your numbers. The earnings grow, or the earnings multiple expands. By and large, the multiple is likely to expand the most in situations where revenue is accelerating. Jed Nussdorf, Soapstone Capital. I tend to look at multiples in absolute terms, and I'm quite comfortable with 12 to 13 time multiples of net income when I believe there's an opportunity for faster growth in earnings, for clearly defined reasons, than the market expects. I do think it's dangerous to lock yourself into rules. So many people miss out on great opportunities because a stock only gets within a quarter point of their price target. I try to avoid being overly rigid. Thomas Russo, Gardner, Russo & Gardner. While price obviously matters, if we're right on the big picture, I don't need a screaming bargain to do well. Compounding value can cover up a lot of sins. Thomas Gaynor, Market Corp. We have learned from experience that the credible expectation of intrinsic value growth is a helpful guard against value traps. We'd rather own a full-priced business with potential 15% per year intrinsic value growth than something at a 30% discount that has no growth. The math works in your favor. Ideally, of course, we're shooting for both the growth and the discount. Steve Morrow, New South Capital. I've read that the average holding period on the New York Stock Exchange is 9 months, which I don't even consider investing. Over such a short period of time, you're just betting on the overall direction of the market or on the next quarterly earnings. I typically don't even make quarterly projections, but I get excited when I see excellent growth potential over time for which I'm paying next to nothing because the market is ignoring it. Aaron Edelheit, Sabre Value Management. Many value investors are primarily focused on price and valuation, which we obviously think are important, but we also believe that when constructing a portfolio you should have companies with promise beyond just going from undervalued to fairly valued. Basic value stocks make up about 40% of the portfolio, and consistent earners blue-chip companies that tend to have long records of steady organic revenue and profit growth, but every once in a while become out of favor, also make up around 40% of the portfolio. The last category we try to own are emerging franchises, which are typically younger companies with excellent growth prospects. Because they often have a narrow product lineup, they fall out of favor when one or a few important products suffer from inevitable hiccups in growth. I often say the only small company we want to buy is one that can become a big company. That's what we're looking for in emerging franchises. William Fries, Thornburg Investment Management. We tend to like equity ideas that have almost bond-like qualities, where cash is being generated in a fairly predictable way and being used to pay down debt or return capital to shareholders through dividends or stock buybacks. Companies in growth mode, reinvesting all of their cash, are more like zero-coupon bonds and are more difficult for us to get our hands around. It's not that we never invest in growth ideas, but it's not our focus. Mitchell Julis, Canyon Capital. We expect to generate the vast majority of our returns not from the growth in the value of the business, but from the unwinding of the value discount. We're more than happy to see growth potential, and we recognize how valuable it can be, but higher growth businesses typically expose us to more valuation risk than we're comfortable with. David Samra, Artisan Partners. The value mindset. While the success of any investment strategy bears heavily on the intelligence and technical skill of its practitioners, value investors also believe their competitive advantage rests upon the unique and multifaceted value mindset they possess. It's an attitude as much as a strategy, born more than bred, and indispensable to their ability to outperform over time. Starting with the first recorded and reliable history that we can find, a history of the Peloponnesian War by a Greek author named Thucydides, and following through a broad array of key historical global crises, you see recurring aspects of human nature that have gotten people into trouble: hubris, dogma, and haste. The keys to our investing approach are the symmetrical opposite of that: humility, flexibility, and patience. On the humility side, one of the things that Jean-Marie Eviard firmly ingrained in the culture here is that the future is uncertain. That results in investing not only with a price margin of safety, but in companies with conservative balance sheets and prudent and proven management teams. If you acknowledge your crystal ball is at best foggy, you follow the advice of Ben Graham and invest to avoid the landmines. In terms of flexibility, we've been willing to be out of the biggest sectors of the market, whether it was Japan in the late 1980s, technology in the late 1990s, or financials in the late 2000s. That wasn't necessarily because of any particular gift of foresight, but reflected a recognition that each of those areas embodied very widely accepted and high expectations. It's painful and not socially acceptable to be out of the most revered sectors in the market, but those types of acts of omission have been a key contributor to the strong performance. The third thing in terms of temperament we think we value more than most other investors is patience. We have a 5-year average holding period. Particularly in a volatile market like today's, people are trying to zig and zag ahead of every market turn that they're hoping they can forecast with scientific precision. We like to plant seeds and then watch the trees grow, and our portfolio is often kind of a portrait of inactivity. That's kept us from making sharp and sometimes emotional moves that we eventually come to regret. Matthew McLennan, First Eagle Funds. The key to the success of value investing is that it is basically contrarian investing. How can you buy something at a value price if it is desired by the world? Investors go out of their way to look for companies with certain cash flow characteristics, returns on assets that are stable and that have objectively verifiable tangible assets that could be liquidated at some point. If that's going to be the focus for literally thousands of funds, how could you possibly have outstanding results by just doing the same thing? Murray Stahl, Horizon Asset Management. It's important to play to your strengths. As an investor, I'm not a home run hitter and can't think of a lot of securities on which I've made 10 times my money. But I also can't think of a lot of securities post-1970 on which I've lost a meaningful amount of capital. Success in investing is not really much more complicated than that. Spencer Davidson, General American Investors. It's hard for most people to grasp that a great company is not always a great stock, and that a great stock is not always a great company. Value works because you're consistently paying less to get more. Over time, that works a lot better than paying more to get less. James O'Shaughnessy, O'Shaughnessy Asset Management. Going against the grain is clearly not for everyone, and it doesn't tend to help you in your social life. But to make the really large money in investing, you have to have the guts to make the bets that everyone else is afraid to make. Carlo Cannell, Cannell Capital. Our worst mistakes have been far more likely a result of our being a follower rather than a leader. We've been much less successful buying into stories that are out there already than ones that we're anticipating in advance. Sam Isley, Orbimed Advisors. It's important to remember as a contrarian investor that the consensus is often right. My colleague Francois Sicart likes to say, just because everyone says it's raining outside is no reason not to take an umbrella. But because we believe the consensus is priced into any given investment, going along with that is a very hard place from which to make money. Robert Kleinschmidt, Tocqueville Asset Management. Value investors tend to have a different default question in looking at a potential opportunity. Most investment managers ask, "Can I own this?" to which the answer is generally yes. Value investors put a different burden of proof on every idea by asking, "Why should I own this?" That degree of skepticism is a valuable trait. James Montier, Société Générale. We do tend to be a little dour at times, and we definitely take a skeptical view of the facts. Warren Buffett once said, "You pay a very high price for a cheery consensus." Value investors simply don't believe in cheery consensus. That's not a criticism. I'd consider it a badge of honor. Daniel Bubis, Tetram Capital. Most investors take comfort from calm, steadily rising markets. Roiling markets can drive investor panic. But these conventional reactions are inverted. When all feels calm and prices surge, the markets may feel safe, but in fact, they are dangerous because few investors are focusing on risk. When one feels in the pit of one's stomach the fear that accompanies plunging market prices, risk-taking becomes considerably less risky, because risk is often priced into an asset's lower market valuation. Investment success requires standing apart from the frenzy, the short-term, relative performance game played by most investors. Seth Klarman, The Baupost Group. What you should do is take a dim view of what's been appreciating and be interested in what hasn't been good to you. You certainly want to understand why any asset class has been going down, but you should celebrate the fact that it has been getting cheaper. To say prices going down is a good reason to look the other way is like saying you'd never go shopping when stores are running sales. Howard Marks, Oaktree Capital. We're classic value investors in the sense that when share prices are low, we think risk is low as well. Most people can understand that in theory, but don't believe it in practice, and even act as if it's heresy. It's actually when prices are rising and stocks are converging with our share price targets that we find risk far more uncomfortable. Sarah Ketterer, Causeway Capital. Someone asked me the other day whether watching what was going on in troubled markets felt lousy, and of course it does. But you can only buy quality cheap when people are afraid. We earn our keep much more in difficult markets than when everybody's serene and happy. David Harrow, Harris Associates. I'm perfectly fine if Mr. Market wants to go down another 15 to 20%. We'll just buy more stocks. It's not during up years that great investment track records are made. Charles DeVoe, International Value Advisors. The market is extremely noisy, but you can't just let that distract you from your discipline and your framework. We've said this since we started out. The market is really just a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. All we're trying to do is keep a level head, sell to the optimists, and buy from the pessimists. Jonathan Shapiro, Kovitz Investment Group. Warren Buffett is right when he says you should invest as if the market is going to be closed for the next 5 years. The fundamental principles of value investing, if they make sense to you, can allow you to survive and prosper when everyone else is rudderless. We have a proven map with which to navigate. It sounds kind of crazy, but in times of turmoil in the market, I've felt a sort of serenity in knowing that if I've checked and rechecked my work, 1 + 1 still equals 2, regardless of where a stock trades right after I buy it. Seth Klarman, The Baupost Group. When you have a model you believe in, that you've used for a long time and which is more empirical than intuitive, sticking with it takes the emotion away when markets are good or bad. That's been a central element of our success. It's the emotional dimension that drives people to make lousy, irrational decisions. Will Brown, Tweedy Brown Company. I like to say that changing investment styles to the latest fad produces the same results as changing lanes during rush hour traffic jams. You increase the risk of an accident with little chance of achieving better results. The psychological pain of sticking to your guns, though, is tough. I was up 35% in 1999, but had people telling me I didn't have enough technology in my fund and they were taking money out. This is not nuclear physics, but it's hard to stick to your guns when the crowd's running over you. We don't believe value investing is ever out of style. It just doesn't work all of the time. Robert Olstein, Olstein Capital Management. The real secret to investing is that there is no secret to investing. Every important aspect of value investing has been made available to the public many times over, beginning with the first edition of Security Analysis. That so many people fail to follow this timeless and almost foolproof approach enables those who adopt it to remain successful. The foibles of human nature that result in the mass pursuit of instant wealth and effortless gain seem certain to be with us forever. So, as long as people succumb to this aspect of their natures, value investing will remain, as it has been for 75 years, a sound and low-risk approach to successful long-term investing. Seth Klarman, The Baupost Group. It is occasionally possible for a tortoise, content to assimilate proven insights of his best predecessors, to outrun hares which seek originality or don't wish to be left out of some crowd folly which ignores the best work of the past. This happens as the tortoise stumbles on some particularly effective way to apply the best previous work, or simply avoids standard calamities. We try more to profit by always remembering the obvious than from grasping the esoteric. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Charlie Munger, Poor Charlie's Almanac. In a world in which most investors appear interested in figuring out how to make money every second and chase the idea du jour, there's also something validating about the message that it's okay to do nothing and wait for opportunities to present themselves or to pay off. That's lonely and contrary a lot of the time, but reminding yourself that that's what it takes is quite helpful. Seth Klarman, The Baupost Group. One investor who has greatly influenced me from a conceptual standpoint is Howard Marks, the chairman of Oaktree Capital. He's not an equity investor, but he describes this notion of running a core strategy focused on beating the market through the accumulation of small but high probability advantages over a long period of time. The alternative, which can also be a legitimate strategy, is to swing for the fences with the goal of hitting enough home runs to drive outstanding performance. The high probability approach is consistent with my personality. Zeke Ashton, Centaur Capital. I feel strongly that attempting to achieve a superior long-term record by stringing together a run of top decile years is unlikely to succeed. Rather, striving to do a little better than average every year, and through discipline to have highly superior relative results in bad times is 1. Less likely to produce extreme volatility, 2. Less likely to produce huge losses which can't be recouped, and 3. Most importantly, more likely to work. Howard Marks, Oaktree Capital. One of the temptations of a professional investor is that one is often drawn towards difficult analytical problems in search of a big payoff. If anything, this temptation has been amplified in recent years by the acclaim and financial rewards that have accrued to those who end up on the right side of a big, dramatic bet. The more complex, the better. The problem is that such success is hard to maintain, hard to predict, and generally creates further pressure to find similarly difficult, large-scale mispricing opportunities to exploit in the future. Such opportunities may not be available most of the time, which may explain why many of those investors who get things dramatically right one year find themselves getting it dramatically wrong the next. At the end of the day, being consistently smarter than the rest of the market is probably next to impossible to do. Zeke Ashton, Centaur Capital. I don't think being a value investor is something you can learn. You can learn how to be better at it and the analytical support for it, but you can't sit there and say, I'm going to make an intellectual decision that I'm going to become a value investor. My personal belief is that you're either born as a bargain hunter type or you're born as a bright-eyed optimist. You have to be skeptical and pessimistic, and you have to really enjoy the bargain hunting process, and it has to be part of your whole life. I find that the people who are the best at this are the type of people who are absolutely thrilled to find a pair of shoes for $20 that they could have paid $150 for at a department store. Richard Pazina, Pazina Investment Management. Some of the best early advice I got was to forget all I'd learned in business school about efficient markets and instead read Ben Graham. You either take to it or you don't, and I knew right away that this was how I wanted to do it. Prem Watsa, Fairfax Financial. We consistently articulate two goals: to achieve positive returns and to outperform the market. If you aren't going to make money owning our mutual fund, then there's no point in buying it. And if you aren't going to make more money than you would have in an index fund, we're not worth our fees. At the end of 2010, I looked at the previous decade for the Oakmark Fund to see in how many quarters we could tell our investors that we both made money and that we made meaningfully more, which I defined as 100 basis points, than the S&P 500. Of the 40 quarters, only 8 qualified as winners. That's like hitting 200 in baseball, just one out away from a ticket to the minor leagues. For those 10 years, however, the fund returned 74% versus 15% in total return for the S&P 500. So even though we were most often frustrated because we lost money or didn't make as much as somebody else, over that period, we beat 96% of the competing funds and did more than 400 basis points better per year than the market. That, to me, is kind of the essence of value investing. We often don't keep up with strong markets, but make up for it by losing less during market declines. Expectations for companies we own are typically quite low, which means they don't usually fall as much as the market does when times get tough. It is a limited set of people who have the personality and discipline to successfully invest this way. I guess that's why we can continue to put food on the table. Bill Nygren, Harris Associates. Value investing strategies have worked for years, and everyone's known about them. They continue to work because it's hard for people to do for two main reasons. First, the companies that show up on the screens can be scary and not doing so well, so people find them difficult to buy. Second, there can be 1, 2, or 3-year periods when a strategy like this doesn't work. Most people aren't capable of sticking it out through that. Joel Greenblatt, Gotham Capital. If you are a value investor, you're a long-term investor. If you are a long-term investor, you're not trying to keep up with a benchmark on a short-term basis. To do that, you accept in advance that every now and then you will lag behind, which is another way of saying you will suffer. That's very hard to accept in advance because the truth is, human nature shrinks from pain. That's why not so many people invest this way. But if you believe as strongly as I do that value investing not only makes sense, but that it works, there's actually no credible alternative. Jean-Marie Eviard, First Eagle Funds. Part 1. Field of Play. Chapter 2. Circle of Competence. In a 1989 Fortune article profiling 10 young money managers under the title, "Are These the New Warren Buffetts?" Marshall Weinberg of the brokerage firm Gruntle & Company recalls a dinner in Manhattan he had with Buffett himself. He had an exceptional ham and cheese sandwich. A few days later we were going out again and he said, "Let's go back to that restaurant." I said, "But we were just there," and he said, "Precisely. Why take a risk with another place? We know exactly what we're going to get." And that is what Warren looks for in stocks, too. He only invests in companies where the odds are great that they will not disappoint. This anecdote says a great deal about a core tenet of successful investing, combining an understanding of what Buffett calls your circle of competence with the discipline to remain within its boundaries. There's certainly no one right circle of competence to have, nor should it remain static over time. But when successful investors talk about ideas that have gone awry, one key reason often cited has been venturing into an industry, company, or market situation with which they don't have experience or don't yet have a full command. Enough can go wrong even when you're in the center of your circle of competence. Why increase the chance of mishap by operating outside of it? Regardless of how broad or narrow their field of play, the best equity investors are able to articulate clearly where they expect to find investing opportunity and why. This circle of competence definition includes the characteristics of companies of interest, with respect to such things as their size, where they operate geographically, their business models, and the industry or industries in which they compete. It also includes the situations that the investor has found can lead to potential share mispricing, such as where a company is in its evolution, where an industry is in its cycle, and when a company or industry is likely to be neglected or misunderstood. All of this informs where the investor will and won't look for ideas, and the tactics he or she uses to generate them. In an interview in 2009, we asked Julian Robertson, the founder of Tiger Management and one of the most successful hedge fund managers of all time, what advice he might have for students interested in pursuing an investing career. He spoke about them getting experience working with the best investors possible and about learning to focus. A baseball player never really gets paid, no matter how many home runs he hits or what his batting average is, unless he gets to the big leagues. Then he's guaranteed to make a lot of money. But in the fund business, you can find a minor league where you can hit for a better average because that's what you're paid on. I remember one of our guys taking us into Korea in the early 1990s, and the market was so inefficient that it was a gold mine if you knew what you were doing. One of our Tiger funds today focuses on gold, a league that is inhabited by some of the crazier investors out there, and it just has a phenomenal record. They know more about gold than anyone else in the world, and they just kill all the rest. My point is that to be successful in this business, you don't have to be better than everybody everywhere, just better than everybody in the league in which you play. It's maybe today more difficult to find those inefficient areas, but it's not impossible. This section assembles the myriad answers the best investors give when asked to explain where they look for opportunity and to justify why they've chosen the focus they have. Again, it's important to keep in mind that there is no narrow set of right answers here. What matters is that some level of clear focus exists and that the rationale behind it is sound. From there, it's all about execution. The right size. One of the most basic distinctions investors make in defining their field of play concerns company size. How big a company is can say a lot about its complexity, the sustainability of its business model, how actively followed it is, the volatility of its stock price, and why it might be mispriced. Practical concerns can obviously come into play. A manager with $5 billion in assets will find it much more difficult to invest in microcap stocks, where he or she might have to own 100% of the company in order to take a position size that is material to his portfolio, than will someone managing $50 million. But managers typically can identify their sweet spot in terms of market cap, or alternatively, should be able to explain why they're agnostic on the point. Our strategy from the beginning has been to focus on areas where we believe we can have some advantage, where there is a greater prevalence for irrationality and higher likelihood of mispriced assets. For us, that's not going to be investing in Microsoft or in some quantitative strategy against a room full of Goldman Sachs PhDs with Cray supercomputers. We have to be guerrilla investors, lying in the weeds and picking off opportunities among the obscure and mundane. That usually means small, ignored companies that no one else is talking about. We'll invest in companies with up to $1 billion or so in market cap, but have been most successful in ideas that start out in the $50 million to $300 million range. Fewer people are looking at them, and the industries the companies are in can be quite stable. Given that, if you find a company doing well, it's more likely it can sustain that advantage over time. We can also take a significant enough stake in any company that, if necessary, we can have an impact on how it's run. James Vanasek, VN Capital. My basic premise is that the efficient markets hypothesis breaks down when there is inconsistent, imperfect dissemination of information. Therefore, it makes sense to direct our attention towards the 14,000 or so publicly traded companies in the U.S. for which there is little or no investment sponsorship by Wall Street, meaning 3 or fewer sell-side analysts who publish research. Money is made in the dark, not in the light. You'd be amazed how little competition we have in this neglected universe. It is just not in the best interest of the vast majority of the investing ecosphere to spend 10 minutes on the companies we spend our lives looking at. I consider myself better off buying an index fund or an ETF rather than trying to figure out how to own Johnson & Johnson or Coca-Cola or Exxon, very high-quality companies with dozens of analysts fine-tuning their estimates by the penny every week. I love Coca-Cola and find its financial characteristics to be outstanding, but how can I have an edge in buying and selling its stock? How can something like that ever be a fat pitch? I would point out that most ignored companies are not investable, either because they're not really public or just complete garbage. But within that flea market is where you find the greatest bargains, so we troll through it to find the small percentage of companies that are ignored for improper reasons. Carlo Canal, Canal Capital. I accept the proposition that public markets are most of the time efficient in pricing large-cap companies, but I've never believed there was sufficient trading volume or research coverage of very small companies to make their prices similarly efficient. So it ought to at least be theoretically possible for an investor in microcaps to have an informational advantage. We focus on companies with an average market cap of $400 million, which either don't have Wall Street coverage or the value added of that coverage is, shall I say, modest. It can turn your stomach, but we also see it as an opportunity that frequent imbalances of supply and demand in the stocks we follow are capable of producing enormous price swings. We found Roger Ibbetson's recent study of the impact of investors' preference for liquidity to be quite consistent with our experience. He's done seminal research on the superior performance over time of small caps over large caps and of value investing over growth investing. But in this case, he found going back over 40 years that investors overpay so much for the perceived safety and lower frictional costs of liquid stocks that the opportunities to earn gains in the less liquid stocks they neglect are significant. One could certainly argue that the extreme increase in market volatility that started in 2008 has exacerbated this inefficiency. David Nierenberg, D-Cubed Family Funds. The potential value added by the research into a microcap company is substantially greater. I have a lot less competition. I'm also much more able to speak directly with the CFO or CEO, who may not be as polished in the ways of Wall Street and might be more open and forthcoming about their business. All of that makes it easier to uncover new and previously unknown facts, which can be an important edge. Paul Sonkin, Hummingbird Value Fund. We focus on smaller cap companies that are largely ignored by Wall Street and face some sort of distress of their own making or due to an industry cycle. These companies are more likely to be inefficiently priced, and if you have conviction and a long-term view, they can produce not 20 to 30% returns, but multiples of that. Robert Robotti, Robotti & Company. Our process is meant to identify where short-term fears have created inefficiencies in pricing, and as you go down in market cap, the market reactions get more extreme. Because so many people are looking at large caps, when a stock gets even a little undervalued, the market tends to take advantage of that. If you're investing in bad news, it's best to look where overreaction on the downside is the biggest, and that's more often in small caps. Cannon Coleman, Invesco. I'm also not going to spend any time trying to figure out what a conglomerate like General Electric is worth. Too many moving parts, and there are so many other people who have to own it that it's very unlikely it will be dramatically mispriced anyway. Zeke Ashton, Centaur Capital. In the same year I started my firm, 2000, I read David Swenson's Pioneering Portfolio Management. He talked a lot about how institutions using a multi-manager approach ought to find managers who concentrate capital in their best ideas and who look off the beaten path to produce above-average results. That dovetailed perfectly with what we thought made sense anyway. The market gets less efficient as you go down the market cap spectrum, so running a concentrated portfolio of around 12 stocks in the least efficient segments would offer the best opportunity to produce above-average returns. We started out primarily in microcaps, which we define as $300 million in market value or less, and have since started a small cap strategy as well, investing in companies with up to $2 billion in market cap. Brian Bears, Bears Capital. We believe we can generate alpha in smaller companies in part because the market overemphasizes the income statement and underemphasizes the balance sheet in valuing them. We try, by focusing first on the balance sheet, to take out some of the risk that comes with relying so heavily on inherently unpredictable future prospects. Bruce Zesser, Advisory Research Incorporated. Maybe the biggest reason small companies outperform is just their entrepreneurial nature. We're almost always more comfortable investing behind management with significant ownership in the business than in big companies, where that's rarely the case. William Naskovitz, Heartland Advisors. We stick primarily to smaller companies because if we can't speak with senior management on a regular basis, we aren't interested. Otherwise, we're just playing with numbers. We've always focused on small caps, but what makes them even more interesting today is that sell-side Wall Street research has never been worse. Everyone has cut back on research staff, which means more and more companies are ignored or getting very superficial work done on them. I was reading an analyst report over the weekend where the price target on the company had gone from $6 to $16, but as far as I could tell, nothing at all had changed. The worse the research, the better the chance we find something that's being overlooked. Candace Weir, Paradigm Capital. Multiples tend to contract further when small companies mess up than when large ones do, so there's more room on the upside when a small company grows out of a turnaround. I'd also argue that it's generally quicker and easier for a small company to be turned around, which improves your chances of investment success. Kevin O'Boyle, Presidio Fund. In my second year at Columbia, I took Bruce Greenwald's value investing class, and on the first day he showed us a table from Eugene Fama and Kenneth French's famous Journal of Finance paper called The Cross-Section of Expected Stock Returns. The table showed how low price-to-book stocks and small caps tended over long periods of time to outperform the market as a whole. The whole idea made so much sense to me that I decided that was the basic direction I wanted to go. Paul Sonkin, Hummingbird Value Fund. I'm never going to run $1 billion while sticking with these teeny-weeny companies. That suits me because I much prefer managing a portfolio to managing the staff I'd need with a lot more assets. Most important, though, is that I just love the thrill of the hunt involved with these type of companies. Why give that up? Paul Sonkin, Hummingbird Value Fund. Small cap investing can be more labor-intensive due to the sheer number of companies, but at the same time you can more quickly know just about everything you need to know about a company to make an investment judgment. I can't say that in looking at a company like AIG, for example. Philip Tasho, Tamro Capital. We're looking for the prospect of an accelerating rate of positive change. That means we're naturally drawn to management changes, turnarounds, or more generally, to situations in which changes in the macroeconomic, competitive, or regulatory landscape require a company to remake what it does or how it does it. That strategy is particularly tailored to small caps. Simpler business models are easier to analyze and cross-check, while at the same time, change happens faster in small companies, making for more investable inflection points. One or two people can also make a big difference, quickly. Mariko Gordon, Daruma Capital Management. The traditional reason for looking at a small-cap stock, which is less liquid, less known, and therefore theoretically riskier, is because it can grow faster. What happens as a result is that people crowd into the same 200 names that are rockstar growers, leaving aside a large number of smaller companies that may still have excellent prospects, but fall between the cracks. We have always been about finding those types of companies and learned through experience early on that 1. You want to invest in companies with great balance sheets. 2. You want to take a long-term view. 3. The price you pay matters a lot. And 4. You have to be diversified. To be good at it, you have to focus on it. So we believe our edge is in bringing a formidable amount of knowledge and experience to a part of the stock market that is not always well understood or effectively followed. Whitney George, Royce & Associates. For quality of business reasons, we now focus on companies with between roughly $1 billion and $8 billion in market cap. The $500 million company is unlikely to have as global a footprint and as diversified a customer base as we want, and the business generally is less mature and more volatile. We've invested successfully in smaller companies over the years, but it can be more hair-raising than I'm comfortable with at our current asset size. We avoid the biggest companies because we want to eliminate the what you don't know risk. With bigger companies, there can be many different business units with distinctly different trajectories, making it harder to identify the core engine that truly drives the bottom line. There's also just a greater possibility that you miss something important, like environmental liabilities or underfunded multi-employer pension plans, or work rules in a region that limit your ability to sell businesses. Jeffrey Ubben, Value Act Capital. I do believe mid-caps to some extent offer the best of both worlds. They're usually not as well followed as large caps, and by the rule of large numbers can have longer growth runways. At the same time, they're broader based and therefore less volatile than small caps, with better liquidity. I also think it's been an advantage that the investing world seems more focused on small cap or large cap exposure, leaving mid-caps relatively neglected. Tom Perkins, Perkins Investment Management. Our sweet spot tends to be in small and mid-sized companies that often aren't particularly well followed by Wall Street. It would be illogical for us to know or uncover something about Procter & Gamble or Texas Instruments before 100 smart analysts did. I'd add that as brokerage firms have gone out of business or cut back on the number of companies they follow, it's not as if we need to focus on tiny or new companies to find those that are relatively ignored. You can find plenty of established, decent-sized companies that just don't get the attention from Wall Street that they once did. Dennis Delafield, Delafield Fund. We try to be cap agnostic, but we do want businesses that are easy to understand, and smaller to mid-sized companies are generally easier to understand. They have fewer divisions, and we can usually get more of our questions answered. Our median market cap in the fund is about $5 billion. Stephen Romick, First Pacific Advisors. We generally want to own only those things that can be bought out. That number keeps getting bigger, but it does tend to keep us out of the very biggest names. Christopher Brown, Tweedy Brown Company. Our sweet spot tends to be in companies with market caps from $1 billion to $5 billion. Illiquidity in smaller cap companies is fine for a portion of your book, but it's nice to have the ability to change your mind and more easily sell if things don't develop as you hoped. The largest companies can certainly be mispriced, but our ability to create an analytical edge, given the number of people looking at them, is more limited. Brian Feltzen, Sheffield Asset Management. The high-quality characteristics we look for in companies to own at the right price tend more often to be in large caps than small caps. We agree with all the arguments that small caps may benefit from persistent market imperfections that can lead them to being mispriced, which is one of the reasons we like them. But the fact is that large caps meeting our criteria get mispriced from time to time as well. Maybe the inefficiency has a different trigger, but whatever the reason, we're glad it exists. C. T. Fitzpatrick, Vulcan Value Partners. It's hard for us to have an edge in analyzing Microsoft's or Intel's business, but we do believe it's possible through understanding macro trends and market psychology, and through the use of a clear valuation discipline, to buy even the most widely followed companies when they're out of favor, and sell them when they're too highly regarded. If Intel's historical valuation range is between 12 and 25 times earnings, with discipline and patience, there should be opportunities to buy at the low end of that range and to sell at the high end, making good money along the way. Ralph Shive, Wasatch Advisors. We gravitate toward larger, diversified companies where the inefficient pricing comes from an excessive focus on short-term issues that we expect to mean revert. If we're wrong, in a big company, our downside risk is limited because there are other parts of the business that can hold up value or even increase overall value if we bought cheaply enough. In my experience, if we're wrong with a smaller company focused on one product or one geography, there's too much risk it's going to zero. Daniel Bubis, Tetram Capital. I build an earnings model from scratch for every material position in the fund, which is the best way to understand the key drivers of the business and its profitability. I'm looking for opportunities in which I have a differentiated view on forward earnings, preferably revenue-driven. By focusing on better-followed mid-cap and large-cap stocks, I can have a much better understanding of what constitutes consensus, and specifically how and where my view varies from it. In smaller companies that attract little attention, it's harder to know the expectations embedded in the share price. Jed Nussdorf, Soapstone Capital. It's much easier to find large-cap stocks that are out of favor. They're on the front page of the Wall Street Journal, and the folks at CNBC are all over them. But in addition to looking for what others don't like, we also look for what is relatively neglected, which are almost always smaller to mid-cap names. In these cases, our anti-consensus view is that the quality of the business and its prospects are just being missed by the market. Robert Kleinschmidt, Tocqueville Asset Management. We want to maintain the discipline that we will invest in a company regardless of size if it meets our criteria. Part of that is because we learn from all the companies we own. Part of that is because it keeps us fresh and engaged and not stuck in the rut of looking at the same 100 companies everyone else is. We also take the position that a penny more in return for our shareholders than we would have had otherwise is a penny worth having. If smaller cap companies can give us that, we'll buy them. Clyde McGregor, Harris Associates. The SEC's Regulation FD, for better or worse, is used by many bigger companies to restrict access to senior management and limit communication to the canned presentation. We learn a lot from sitting down with management at smaller companies and really talking about their businesses, competitors, and opportunities. Edward Studzinski, Harris Associates. The information inefficiency tale commonly told about the small-cap universe is overhyped. In a diversified institutional portfolio with 50-plus names, you're deluding yourself if you think you can have some unique inside scoop on more than a handful of the names you own. That's all the more true in recent years, with all the concentrated hedge funds out there selling themselves as small-cap experts. James Kiefer, Artisan Partners. Industry preference. Central to any accomplished investor's definition of his or her circle of competence is a description of the industries, or more generally, the types of businesses, on which he or she focuses. Hard-earned experience would appear to be the most impactful teacher here. The emphasis is usually more on where they will not invest, rather than on where they will. Stepping outside your areas of competence is often a seductive siren song, but I've learned from experience not to listen anymore. Without the confidence that comes from experience and the ability to recognize patterns, the risk is higher that you'll overpay or sell too soon in a panic. If you're a value investor, it's pretty easy to explain to yourself or your investors why a deep value idea hasn't worked out yet. But if you bought JDS Uniphase at $100, which was down from $200 but on the way to $2, that's tougher to explain. Sean Kravitz, Esplanade Capital. The more specialized the knowledge necessary to understand a business, the less likely we'll invest in it. Who's going to be the better biotech investor? The person who ran drug trials for Merck for 25 years? Or us? We do little in pharmaceuticals, healthcare, and computer technology. James Vanasek, VN Capital. We've struggled to underwrite moats based on intellectual capital, say in a company like Qualcomm, where its earnings power is enormous if all its patents hold up. That's another reason we're not active in things like pharmaceutical or biotech companies. James Crichton, Scout Capital. In general, the best thing for us is to find companies that have really stumbled, but where you can look at their past and understand why they are going to earn something much better in the future. That's opposed to looking at a company like Amazon.com, for example, which might be a great business, but where understanding exactly what the model is going to be in the future isn't easy. It's a lot easier to look at the prospects for a railcar manufacturer whose business has been the same for decades. Stephen Romick, First Pacific Advisors. We don't typically bet on scientific innovation, so we rarely find things we'll consider in healthcare. We avoid any areas in technology because of the speed of the product cycles and the magnitude of change from cycle to cycle. Adam Weiss, Scout Capital. Successful technologies change something, creating an efficiency or demand that wasn't there before. But the very fact that the change happens means that somebody else can come along and change it again. If, because of the threat of technological obsolescence, I'm uncertain about a company's cash flows several years out, I'll put a big discount on those cash flows and conclude they're not worth much. Because Wall Street tends to put a large value on the future cash flows of technology companies, we rarely find one that we consider very attractive. Ed Wachenheim, Greenhaven Associates. Back in the late 1990s, we invested in a few too many concept stocks, earlier stage companies with developing technologies where the stories were compelling and indicated that there would be considerable future value. The problem is that without a real underpinning of asset value or earnings, these types of companies can run into big trouble when the thesis doesn't pan out as quickly as expected, or new competition disrupts the story. Randall Abrahamson, Trapeze Asset Management. We're drawn to companies with long product life cycles, in which the product or service will be more or less the same 5 years from now. If that's not the case, we don't believe we can with adequate confidence make reliable long-term earnings forecasts. Murray Stahl, Horizon Asset Management. We'd like to believe any business is analyzable, but when you have product cycles of only 12 months, as an investor, you're very reliant on the company hitting that window exactly right. If they don't, and somebody else does, you can buy low all you want, but you'll find out pretty quickly that you were buying a future income stream that was a mirage. We haven't sworn off technology entirely, but we've essentially sworn off investing in short product cycle technology. We look for technology companies where the business cycles are glacial in comparison. Larry Robinson, Glenview Capital. We're typically not attracted to most technology businesses because of cutthroat competition, potential technology obsolescence, short product cycles, and the excessive use of stock options. The return on time is also a problem. You spend so many hours analyzing new products and technology trends that 50% of your time gets spent on 5 to 10% of your portfolio. At the same time, technology is an important driver of economic growth and grows at above GDP rates, so we want to have exposure to it. We like to attract difficult industries through the side door, so to speak. With Arrow Electronics, for example, we can own a leading distributor of technology products, including semiconductors, software, and electronic components, that supplies mostly small and medium-sized companies. That allows it to benefit from the growth in high-tech without the typical risks associated with tech stocks. Pat English, Fiduciary Management Incorporated. I first got interested in technology stocks after watching things like Micron Technology go from $20 to $40 to $20 to $40 to $20 to $40. The cyclicality in many of these businesses can be more regular than is often believed, so it's possible to buy on the down leg of a cycle because there will inevitably be an up leg. We had considerable success, in particular in buying technology companies that also have great balance sheets. Companies like this have the flexibility to invest in new initiatives, buy new technology, and invest in R&D. Even if they aren't profitable today, you have the potential for a gold mine if the business turns around. John Buckingham, Al Frank Asset Management. From the beginning, we have occasionally come across products or technologies that we thought were too compelling to ignore by sticking rigidly to our playbook. These ideas are higher risk, and so they won't make up a big part of the portfolio, but we make room for them when the potential is as high as we think it is. Charles Makel, Avenir Corp. Circle of competence essentially comes down to whether we understand the business. There are several sub-questions under that. Do we know the right people in the industry? How well do we understand the products and the customer decision-making process? Are there unanalyzable things that could have a big impact? No matter how well you understand the steel industry, for example, there's tremendous volatility and variability in the business that may not be susceptible to prediction, which makes it difficult for us to underwrite the business with adequate confidence. James Crichton, Scout Capital. We tend to find more special situation in industries with higher cyclicality, which most often aren't the most glamorous sectors of the economy. How companies both prepare for and respond to industry capacity utilization rates going from 100% to 30% and earnings falling off a cliff has a dramatic impact on their future prospects. If the down cycle makes entry points attractive, that can create excellent opportunities. Vincent Salecchia, Delafield Fund. We find that at times companies or even industries can trade at big discounts to their inherent growth rates because of the perception that earnings are highly cyclical. John Jacobson, Highfields Capital. We're far more interested in cyclical companies that are well capitalized, that don't lose money at the bottom of the cycle, and whose peaks and troughs are both higher over time. We'd be less apt to buy into something like a capital-intensive pulp and paper manufacturer, which bleeds money at the trough end, and when they do generate some cash flow, needs to spend much of it on new or upgraded plant and equipment. Charles Delardemel, International Value Investors. Cyclical industries don't scare us if we understand the long-term supply and demand dynamics of the industry and believe that the company we're interested in is on the right side of that. We think, for instance, that insurance is a lousy business. There's way too much capital, too little differentiation, and way too many managements doing the same dumb things. That's all contributed to there being a generally soft pricing market for 6 or 7 years. That said, we're happy to own insurance companies that don't think like everyone else and zig when others zag. Steve Morrow, New South Capital. We don't have a problem with cyclicality. Wall Street still looks for certainty in areas that are uncertain. We feel good about lumpiness. We just try to be cash counters. If you can buy something at 5 times free cash with limited chance of permanent impairment, even if it earns only half of what we thought, that's okay. Bruce Berkowitz, Fairholme Capital. The downside of an industry cycle is a consistent reason why things get cheap. We'll put a reasonable multiple on the normalized earnings power of the business over 3 to 4 years, knowing it can take 5 or 6, and given the types of things we look at, often come up with intrinsic values that are 3 to 5 times where the stock is trading today, which is not to say the wait can't sometimes be painful. Robert Robotti, Robotti & Company. Cyclicals, by their nature, repeatedly experience boom and bust periods that create opportunities for investors like us, who pay careful attention to supply and demand economics and believe in mean reversion. If you look at the average quality holding period over the last 15 to 20 years, it's clear that there are a lot of people out there just renting stocks. The primary inefficiency we're trying to exploit is that investors don't like it when things aren't going well, and a company is under-earning its potential, or what's normal. So our focus on the long side is to identify overreactions in stock when that happens. Companies can get put in the penalty box if they stumble. It doesn't happen all the time, but reliably enough that we're rarely at a loss for ideas by focusing on cyclical but temporary issues in a company's business. Brian Feltzen, Sheffield Asset Management. High-quality businesses tend to be characterized by things like strong brand names, customer loyalty, pricing control, some cost advantage, and growing long-term markets. Low-quality businesses, which don't have much control over their futures, exhibit the opposite characteristics. We generally consider cyclical commodity businesses to fit this more negative profile, and so are less invested there. Bill Nygren, Harris Associates. There can certainly be a cyclical component to what we find interesting, but the more salient observation is that there is variability over time in how the market looks at the company or industry. Perceptions don't vary much for things like electric utilities or even a stable blue-chip business like Coca-Cola. In those cases, it's difficult for us to find the valuation dispersion and reflexive selling at nonsensical prices that we look for. Brian Barish, Cambiar Investors. We're unlikely to invest in a pure cyclical like a steel company, where the returns are governed primarily by macro forces. Boykin Curry, Eagle Capital. In areas like basic materials and other commodity businesses, there usually just aren't enough of a moat, which makes it hard for us to get interested on a fundamental basis. Adam Weiss, Scout Capital. I'm very leery of any business that is so cyclical that it burns cash at or near the bottom. I've concluded there are enough alternatives out there that I don't need to accept that kind of risk. Chris Middleman, Middleman Brothers, LLC. One of the lessons I took from Warren Buffett years ago was to define the areas you're comfortable with and stick to them. I generally stay focused on food, beverage, and tobacco companies. Branded consumer businesses are those for which I have a natural affinity, and I think I understand. While I would have a hard time on the weekend observing what DRAM chip is in the cell phone of the person walking next to me, I pay a lot of attention to, and think I learn a lot from, what people are wearing, or eating, or smoking, or drinking. Of course, these are also all businesses that lend themselves to the types of global growth opportunities I most value. I'm always tempted to look in other areas, but I come back to asking whether my ability to gather information and develop insights about a business are substantive enough to justify a position I want to own for a very long time. That happens very rarely. Thomas Russo, Gardner Russo & Gardner. There is something inevitable to me about positional goods. Once you've provided for your basic needs, you start to march up the consumption curve, and it is often the more traditional brands that attract the consumer as he reaches a new position in life. The more you prosper, the more narrow the universe of items through which you can express your prosperity. Thomas Russo, Gardner Russo & Gardner. We prefer companies without heavy reinvestment needs. The average company has to pour more than half its earnings every year back into the business to maintain itself. If you don't have to do that, like most consumer products companies, for example, you have more to invest in new businesses, to give back to shareholders, or to keep on hand for a rainy day. That's a huge advantage that we don't think people are correctly evaluating. Stephen Yachtman, Yachtman Asset Management. I like to invest in consumer brands in areas like chocolate, whiskey, beer, and wine. These are products that have been around for 1,000 years, that people like, and I don't think that's going to change. Changes in technology or the trend toward outsourcing don't diminish the fact that people like to have a drink at the end of the day, or that they enjoy chocolate. Thomas Gaynor, Markel Corp. I've always had an affinity for companies that actually make things. We favor companies with transparent businesses that we can understand fairly quickly, and those that have large and recurring maintenance, repair, and overhaul revenues from an installed base, such as elevator companies or aerospace parts firms. Alexander Ropers, Atlantic Investment Management. We're focused on 4 sectors that have exhibited unvarying demand regardless of economic activity, and that have key fundamental strengths that help explain why they've been around for hundreds of years. The inherent demand of people to smoke, drink, and gamble, and of nations to arm themselves is clearly strong and long-lasting. Charles Norton, The Vice Fund. I'm biased more towards industrial and capital goods businesses, which I find more rational than those that are tied primarily to consumer demand. I'm not much of a consumer myself, so I don't have a great feel for what makes a lasting consumer business. Why do people like Coach bags? How do you predict the extent to which they'll like them tomorrow? I just don't know. When Motorola was doing so well with the Razr phones, I didn't recognize what a fad that was and got hurt in the stock as a result. Ralph Shive, Wasatch Advisors. I have often made the mistake of investing in a business that needed and used more capital to operate than I thought they would. That's one reason I tend to avoid heavy industrial companies. Some very smart people own General Motors now. I hope they make money, and it's probably good for the country if GM survives, but I can't figure out how to make that work as an investment. We just don't own those types of companies. Thomas Gaynor, Markel Corp. One thing about being an investor for 20 years is that experience leads you to write off big chunks of the market. I don't do retail because you have to recreate the demand every day. I don't do financial services because it's a spread business with no real free cash in it. You have to grow equity to grow assets to make more spread. I don't do much in industrials because the capital demands are high, and long-term, the cost structure, particularly with labor and energy prices, is challenging in a global economy. I don't do commodities. We like price makers that set prices based on value added, as opposed to price takers. If you buy a high-quality business, you only have to be right once, buying at the right price. The sale is fairly easy to execute. In cyclical or commodity areas, you have to be right twice, on the buy and the sell. If you miss the exit, it might be a while before it comes back around. Jeffrey Ubben, Value Act Capital. It's easier to describe what we don't do: oil and gas, commodities, utilities, and biotech. We fundamentally believe that energy and commodities have been value-destroying businesses over time. At the same time, their value tends to be driven by the price of a commodity that we have no ability to predict. With utilities, they don't tend to be businesses that can create excess value. They might be nice surrogates for bonds, but not much more. In biotech, we just have no illusions that we know how to analyze the business. Outside of these few areas, just about anything else is fair game. Ricky Sandler, Eminence Capital. As long as it's a good quality business selling at an attractive price, I don't care much about what the company makes or sells. One thing we are very conscious of is the degree of leverage in a business. That can be financial leverage, which is reflected on the balance sheet. It can be operational leverage, where you look at how much of the cost base is fixed or variable. It can also be the degree of leverage to a particular industry or geography. In general, I'm uncomfortable with companies that are vulnerable to more than one of those kinds of leverage going against them at the same time. A cyclical business that has a lot of fixed cost, for example, should not have a lot of financial leverage or be too leveraged to one geography or industry. If things go the wrong way, management has its hands tied in trying to get out of trouble. This is a big reason we rarely find opportunity in more commodity-type businesses. David Harrow, Harris Associates. We avoid industries in which information arbitrage is extremely important to stock prices. I don't think we'd buy a single-product biotechnology firm, for example. The same holds true in a crisis situation like Bear Stearns in 2008. I had no idea whether it was a zero or if it was going to be fine. In cases like that, our time horizon advantage is dwarfed by our competitors' short-term information advantage. Boykin Curry, Eagle Capital. We believe in reversion to the mean, so it can make a lot of sense to invest in a distressed sector when you find good businesses whose public shares trade inexpensively relative to their earnings in a more normal environment. But that strategy, in 2008, led many excellent investors to put capital to work too early in financials. Our basic feeling is that margins and returns on capital generated by financial institutions in the decade through 2006 were unrealistically high. Normal profitability and valuation multiples are not going to be what they were during that time, given more regulatory oversight, less leverage, and thus capital to lend, higher funding costs, stricter underwriting standards, less demand, and less esoteric and excessively profitable products. Stephen Romick, First Pacific Advisors. One way of dealing with information being more available is to stop playing the game and seek out securities or asset classes where there's less information or competition. Seth Klarman, The Baupost Group. We tend to be less invested in areas in which there's less differentiation between the winners and the losers, and in which results are more macro-driven than company-specific. We typically do not have significant investments in utilities or REITs, for example. Lee Ainslie, Maverick Capital. We don't like businesses that are completely reliant on human capital that can walk out the door. We have no rule against it, but you generally won't find us investing in things like investment banks or consulting firms. Don Noon, VN Capital. Because 5 or 6 unique holdings make up 60 to 70% of each of my portfolios, I exclude companies with idiosyncratic risk profiles that I consider unacceptable in such a concentrated portfolio. That means I exclude high-tech and biotech companies with technological obsolescence risk, tobacco or pharmaceutical companies with big product liability risks, utilities and other regulated companies where the government can change the rules of the game, and companies that lack sufficient transparency, like banks, brokerages, and insurance companies. Alexander Ropers, Atlantic Investment Management. We have not done well in fashion-related businesses, which I'd extend to retail, where our record is almost unblemished by success. We tend to be susceptible to value traps in these businesses. One example was our investment years ago in Bombay Company, a home furnishings specialty retailer. We were attracted by an enthusiasm for the CEO, combined with the apparent financial anomaly of a company trading at only 30% of its $700 million in revenues. We would still be awaiting the turnaround had we not decided to sell out at a modest loss and move on. David Nierenberg, D-Cubed Family Funds. We've never been that fond of the hotel business because the tenants move out every night. That makes the business susceptible to economic swings in a way that office buildings with long-term leases to creditworthy tenants aren't. We prefer to see more predictable streams of cash flow than lodging companies typically have. Michael Weiner, Third Avenue Management. Some areas lend themselves better to our types of analysis than others. It's very hard for us to figure out what brands are worth, for example. It's also hard for us to figure out what future scientific developments are worth. We tend to stay away from those kinds of things, but at the right price, we'll consider anything. David Einhorn, Greenlight Capital. Most people say they want to stay within their circle of competence, and that's smart. But there's no reason to say, here's my circle of competence, and guess what? It's never getting any bigger because I'm not going to learn anything new. We're trying to understand new things if we can. Bill Miller, Legg Mason Funds. There's a real premium in this business on innovation. That doesn't mean chasing the latest fad, but it does mean recognizing new opportunities and taking advantage of them, even if they don't fit exactly into your historical playbook. Jeffrey Tannenbaum, Fir Tree Partners. I have a problem with the concept of circle of competence as defined by many value investors who won't invest in energy, won't invest in commodities, won't invest outside the U.S. This business requires constant learning, even sometimes abandoning precepts about industries and geographies that no longer apply. If you're not willing or able to do that, I think the environment ahead means you're in for a very tough time. John Burbank, Passport Capital. Where in the world? When we first started interviewing highly accomplished investors for Value Investor Insight in early 2005, a U.S.-centric focus was more the norm than the exception. For any number of legitimate reasons, language barriers, accounting principle differences, limited research capacity, value investing orthodoxy still argued for geographic focus rather than expansiveness. While this stance remains prevalent, in clear ascendance is the argument that as industries and companies have become ever more global in scope, so must the investors who follow them. Regardless of the position taken, all investors today must think carefully about their geographic field of play and how they expect to cover it. It has become increasingly clear to me that the best opportunities in coming years are going to be outside the U.S. That wasn't the case when I started out, when buying a stock in Canada seemed awfully unusual to people. Over the past 5 years, we've more than doubled our international exposure to the point where 65 to 70% of our portfolio on a look-through basis is invested outside the U.S. Companies able to tap into growing affluence and people's innate desire to improve what they eat, what they wear, and how they live will have decided advantages over those focused on mature economies like the U.S. and Europe, where deleveraging will take a long time to work out. David Winters, Wintergreen Fund. From day one, we've had a significant portion of our assets invested outside the U.S. It's currently about 30% of our gross exposure. This is probably too broad a generalization, but in our view, non-U.S. markets tend to be less efficient than the U.S. market. If you look at our core opportunity set, which we define as the 3,000 or so stocks that trade more than $10 million a day, on average, we took advantage, in 2005, of about 12% of the available opportunities in the U.S., 6% in Europe, and 3% in Asia. In an ideal world, I'd like to be more selective in the U.S. and take advantage of more opportunities outside the U.S. Lee Ainslie, Maverick Capital. I'd argue that literally every investor today has to be a global investor to understand what's going on, certainly in markets like energy and commodities, but also to take advantage of where we think the best opportunities are going to be. John Burbank, Passport Capital. We believe it's prudent for long-term investors to have a significant and growing portion of their portfolios allocated to equities in foreign countries that are growing faster than the U.S. and whose currencies will likely appreciate against ours. David Nierenberg, D-Cubed Family Funds. In general, you still see less long-term commitment to owning equities by investors outside the U.S. When markets run into trouble, you'll see more wholesale selling of equities by big non-U.S. institutional holders. There may be some historical precedent to that, but we hope it continues. Will Brown, Tweedy Brown Company. We probably held 35 to 40% in non-U.S. stocks 5 years ago, and that number today is closer to 70%. Most of that is a result of company-by-company assessment, but I will admit to casting an eye toward history and wondering if today's U.S.-centric investor isn't like the similarly positioned British investor in the early 1900s, who would have left a lot of money unearned as a result of his nation losing economic relevance due to progress elsewhere, while he or she stayed invested only domestically. Thomas Russo, Gardner, Russo & Gardner. There's increasingly a distinction without a difference. Nestle is Swiss, Diageo is British, Johnson & Johnson is American, and Philip Morris International is headquartered down the street from us, but no longer has any business in the U.S. We own all of them, and in most of the ways that matter to investors, the analysis and valuation of their businesses is very similar. Businesses are dynamic entities, moving capital and assets to maximize opportunity. They increasingly operate on a worldwide basis, so we have to as well. We found that knowledge of businesses and companies is quite transferable, and have often applied our experience in one market to another. For example, we've had success over the past several years in buying Coca-Cola bottlers at different times and in different markets. Will Brown, Tweedy Brown Company. Another reason it's important to be more international in your outlook? If you're not paying attention to what competitors in emerging markets can do, you're likely taking on risk with U.S. company investments that you shouldn't. Robert Williamson, Williamson Macquarie Investment Partners. For our type of investing, which involves buying big stakes in companies and investing for the long term, we need transparency and a firmly established rule of law. If we can't believe the financial statements or see too much risk of the rules being changed after the game starts, the whole exercise is pointless. As a result, we won't invest in Russia. We've also never owned a mainland Chinese company because most of them are controlled by the state, and there's too much potential conflict between shareholder and state interests. David Harrow, Harris Associates. The foundation of our process is the ability to arrive at a reasonable estimate of intrinsic value, which is often undermined in emerging markets by a variety of reporting, governance, legal, and regulatory obstacles. In South Korea, for example, consolidated financial statements aren't always available. In Russia, the government hasn't kicked the habit of controlling companies that are supposed to be owned and controlled by shareholders. Even in countries where government is less intrusive, regulation can be inconsistently and unfairly applied, adding uncertainty to business models that makes forecasting very difficult. At a low enough valuation, of course, the incremental uncertainties can be worth taking on, but valuations have only rarely gotten low enough in emerging markets relative to the developed world for us to step over the border. It's not for lack of effort. We're always looking, but so far, we've found plenty of opportunity elsewhere to keep us busy. Dan O'Keefe, Artisan Partners. For better or worse, the Anglo-Saxon business model puts the interests of shareholders first. We are less comfortable in markets where loyalties are more divided. Jeffrey Schwartz, Metropolitan Capital. There are still language barriers, particularly in Japan, but that's gotten better over the years as English has become firmly entrenched as the international language of business. Culturally, in some parts of the world, we're up against a kind of social democracy attitude that says shareholders are equal constituents with employees and customers and suppliers and banks. I don't ascribe to that at all, so in some cases we have some convincing to do. Most often, if that attitude is too prevalent, we just won't be very active. David Harrow, Harris Associates. We like to operate under the illusion that if we see something that is out and out unacceptable being done, that there's a clear rule book and well-defined avenue to complain about it. It's not clear that's yet the case in China. Will Brown, Tweedy Brown Company. In general, there aren't many countries in which we wouldn't invest, but if a country is too economically or politically troubled or the rule of law doesn't really prevail, we pass. The main country in which we won't invest today is Russia. There's still too much risk for foreign or even local investors that you'll think you own an asset and then Mr. Putin decides you don't. Jean-Marie Evillard, First Eagle Funds. We do very little direct investing in Eastern Europe, where the level of disclosure and the quality of corporate governance is still poor. Many leading companies are controlled by government-related entities or majority shareholders who couldn't care less about the interests of minority shareholders. We also aren't very active in the UK. London has its own well-established and well-capitalized investment community, so we find value there is arbitraged out quicker than it is in continental Europe. Richard Vogel, Aletis Capital. For the types of company I generally invest in, sophisticated global companies like Diageo, Nestle, Pernod Ricard, the information is generally accessible and complete, so I don't require a greater margin of safety or lower multiples because they're international. Also, partly because the field hasn't been as crowded, I've had as good, if not better, access to senior management at non-U.S. companies. Thomas Russo, Gardner, Russo & Gardner. We're not afraid of political risks, which we generally think are exaggerated. We invested in Thailand after the coup. We're investing in Turkey in the face of political uncertainty. It's not a big component of what we do, but there are always small pockets of mispriced risk, and political uncertainty can create very nice bargains. Oliver Kratz, Deutsche Asset Management. Over the next 10 years, it's far more likely that the huge amount of capital owned by the rest of the world will grow by investing somewhere other than the U.S., whether it's in infrastructure in China or in the Middle East, or to develop consumer markets in places like India. John Burbank, Passport Capital. We haven't been traditional emerging markets investors because we do not chase growth or glamour, but we like nothing better than to invest in emerging markets on a contrarian basis. Strong economic growth is never steady, so you can find nice opportunities to invest after booms have gone temporarily bust. Charles DeVoe, International Value Advisors. One of the keys to Warren Buffett's early success was investing in high return on capital consumer businesses that were relatively immature when he bought them and that grew enormously along with the U.S., the largest economy in the world. He owned companies like Gillette, Wells Fargo, and Washington Post Company over a period in which consumer products, financial, and media companies grew from being a relatively small part of the S&P 500 to a very large part of it. That's a natural evolution in any large developing economy, and we expect that dynamic to create considerable value in places like India for a long time. John Burbank, Passport Capital. We keep heading more toward direct international investing, but worry that we're going to be the patsy. We looked at South Korea, but kept asking ourselves what edge we really had there. How do we understand the culture, the management? The U.S. is going through the same decline faced by all past great civilizations. It's in the nature of things. It takes a very long time and happens in 10,000 different ways. All smart companies and investors need to respond to that. We actually look at our energy bets as more of a global play on the fact that 3 billion new capitalists in Asia are going to have a significant impact on future energy demand. The good thing about investing is that you don't have to do everything to be successful. There are plenty of different ways to make money. Bruce Berkowitz, Fairholme Capital. Because we put such a strong emphasis on companies based in close proximity to us, 2/3 of our portfolio companies are in the upper Midwest, with 50% very nearby in Minneapolis-St. Paul. We commit ourselves to knowing all the public companies in that limited universe very well. Our initial research is very qualitative, focused on getting to know management and letting them explain what their markets are, how they're addressing them, where they're investing, and how they make those investment decisions. From that, we also want to learn from various other constituencies, from suppliers to customers to current and former employees. All of that is considerably easier when you're close to where these people are. William Frells, Mars and Power Incorporated. My feeling is that it's beyond my skill set to try to buy local companies outside the U.S. Some people will make a lot of money doing that, but not me. What I am doing is buying companies like GE and Citigroup and Diageo, who already have tremendous expertise and operations outside the U.S. to take advantage of international growth and development opportunities. Thomas Gaynor, Markel Corp. I once heard someone say that every time you double the distance from where you are to where you are investing, you should divide the quality of your assessment in half. Francisco Garcia Paramas, Bestinver Asset Management. I did have the good fortune in the 1980s and into the 1990s to have our style of value investing not be widely practiced, particularly in continental Europe. Value stocks were largely neglected, and it was possible, if one was willing to be patient, to often buy them for a song. That's no longer true. Many of the more secular inefficiencies are gone. But the fundamentals of value investing, which to my mind are based on common sense, still work, and work equally well across borders. We look at stocks exactly the same way, whether in Hong Kong or Japan or Paris. People always ask, but don't you want to invest like the locals, understanding the local idiosyncrasies? And my answer is simply no. We never buy stocks based on what we think other investors are going to do. Jean-Marie Eviard, First Eagle Funds. People tend to lump international investing into this general bucket of opportunity, which is kind of silly. We expect a closing of the relative GDP per capita gap between the developed world and many emerging markets, but as that happens, we believe you're still going to have stocks be cheap or expensive based on cyclical ups and downs, and on valuations that overshoot and undershoot. Unless you're smart about picking your spots, you're not going to be successful no matter where you invest. David Samra, Artisan Partners. Chapter 3. Deficient Market Hypothesis. An all too common error that novice investors make is to assume a consistent connection between the success of a business and the success of an investment in that business. There's no question that successful companies can be outstanding investments, but that's not necessarily the case. Winning investments arise when the current market price of a company's stock underestimates what you believe its current value is, and you turn out to be right. The market today has to be missing something, say level and/or timing of future cash flows or the value of hidden assets. These are the inefficiencies that most strident efficient market hypothesis proponents argue don't exist, but which smart investors count on for their success. Longtime daily racing form publisher Stephen Crist captured this verity well in describing how to think about betting on horses. The issue is not which horse in the race is the most likely winner, he says, but which horse or horses are offering odds that extend their actual chances of victory. There is no such thing as liking a horse to win a race, only an attractive discrepancy between his chances and his price. Look at almost any company's market value over a multi-year period if you want to assess the efficiency of the market. Even the largest, most stable, and most liquid company will often exhibit a surprising variability in market price from high to low, a variability that almost certainly goes beyond the underlying change in the company's actual value. This spells opportunity for astute investors. In articulating any investment strategy, then, managers should be able to describe the typical inefficiencies on which they are looking to capitalize and the types of situations in which they expect to find them. For any given idea, they should be able to explain how their view on a company's prospects differs from what is built into the current share price. Quite simply, if an investor doesn't know why something might be mispriced, the chance of it actually being mispriced significantly decreases. The human element. The Baupost Group's Seth Klarman has proven not only to be one of the best investors of his generation, but also one of the most articulate in explaining the underlying value investing principles on which his strategy is based. In one of the many annual letters that he allowed us to excerpt in Value Investor Insight, he captured nicely a common impetus for market inefficiency: the human element involved in the setting of prices. Imagine that every adult in America became a securities analyst, full-time for many, part-time for the rest. Every citizen would scour the news for fast-breaking corporate developments. Some would run spreadsheets and crunch numbers. Others would analyze competitive factors for various businesses, assess managerial competence, and strive to identify the next new thing. Now, for sure, the financial markets would have become efficient, right? Actually, no. The reason that capital markets are, have always been, and will always be inefficient is not because of a shortage of timely information, the lack of analytical tools, or inadequate capital. The Internet will not make the market efficient, even though it makes far more information available, faster than ever before, right at everyone's fingertips. Markets are inefficient because of human nature, innate, deep-rooted, permanent. People don't consciously choose to invest with emotion. They simply can't help it. All human beings are susceptible to the emotions and biases that can cause stock prices to be inefficiently priced. The best investors would appear better able to keep theirs in check and to recognize when the emotions and biases of others are creating investment opportunity. At the center of all market pricing are human beings. I joke that the four horsemen of the investment apocalypse are fear, greed, hope, and ignorance, only one of which is not an emotion. Fear, greed, and hope have wiped out more money than any market downturn ever could. Because of all the foibles of human nature that are well documented by behavioral research, and now by neurological research, people are always going to overshoot and undershoot when pricing securities. A review of financial markets all the way back to the South Sea Company nearly 300 years ago proves this out. As long as human nature doesn't fundamentally change, we can continue to arbitrage the pricing inefficiencies it creates. James O'Shaughnessy, O'Shaughnessy Asset Management. The mood swings of the securities markets resemble the movement of a pendulum. Although the midpoint of its arc best describes the location of the pendulum on average, it actually spends very little of its time there. Instead, it is almost always swinging toward or away from the extremes of the arc. In fact, it is the movement toward an extreme itself that supplies the energy for the swing back. Investment markets follow a pendulum-like swing between euphoria and depression, between celebrating positive developments and obsessing over negatives, and thus between overpriced and underpriced. There are a few things of which we can be sure, and this is one. Extreme market behavior will reverse. Those who believe the pendulum will move in one direction forever or reside in an extreme forever eventually will lose huge sums. Those who understand the pendulum's behavior can benefit enormously. Howard Marks, Oaktree Capital. I'd argue the market isn't terribly efficient any of the time. Underpinning the efficient markets hypothesis is the notion that markets tend toward an equilibrium price and that there's a normal distribution around that efficient price. It's a nice theory, but I don't see evidence for it in the real world. Quite the opposite. Valuations tend to orbit some sort of appropriate valuation, but spend no more time in the middle of the range as they do at the various ends. It's not a normal distribution at all. We focus on taking advantage of reflexive selling that we don't believe is well considered. It may be due to some recent bad news at a company or from the perceived impact of a more macro trend or event. We become increasingly interested in a stock as misinformation and disinterest on the part of sellers serves to compress its valuation. Brian Barish, Cambiar Investors. I had an inkling that 2009 would be a good year when Institutional Investor magazine published an article in late 2008 titled The Death of Value Investing. In my experience, death of articles usually mark a turning point, irrespective of the subject. In this instance, I was struck not only by the article's potential as a contrary indicator, but also by the utter preposterousness of its assertion. For value investing to die, either humanity would have to die too, or people would have to become entirely and consistently rational. The very reason price and value diverge in predictable and exploitable ways is because people are emotional beings. That's why the distinguishing attitude among successful investors is temperament, rather than brain power, experience, or classroom training. They have the ability to be rational when others are not. Brian Chekabowski, Abingdon Capital. I was originally trained as an economist, and it took me 2 different degrees in economics to work out that it really wasn't what it purported to be. It claims to be a science of behavior, but actually all of the behavior was assumed. I became disenchanted with that, and the longer I worked in the markets, the more I became convinced that the paradigm of rational economic beings was deeply, deeply flawed. It just didn't match up with the reality I was observing. James Montier, Société Générale. Human beings are subject to wild swings in their levels of fear, risk tolerance, and greed. That won't change. I base my whole approach on buying when others are fearful and selling when others are greedy. The reason Shakespeare is so relevant still today is that his plays were all about human nature, and human nature never changes. Mark Sellers, Sellers Capital. I've been around long enough to see irrationality in all flavors, so less and less surprises me. I no longer think I must be missing something and realize the madness of investor crowds can do some nutty things. Ricky Sandler, Eminence Capital. It's always important to ask whether you have any competitive advantage in analyzing a particular company. Can we know the business better because no one else seems to be paying attention? Is the market's view being distorted by some behavioral or structural bias that we don't have? Brian Bears, Bears Capital. An argument is made that there are just too many question marks about the near future. Wouldn't it be better to wait until things clear up a bit? You know the pros. Maintain buying reserves until current uncertainties are resolved, etc. Before reaching for that crutch, face up to 2 unpleasant facts. The future is never clear, and you pay a very high price for a cheery consensus. Uncertainty actually is the friend of the buyer of long-term values. Warren Buffett, quote from Forbes. Comfort in investing comes at a high cost. Selling stocks in 2007 would have felt uncomfortable, but in retrospect we all should have done more of that. Buying or even holding stocks in early 2009 was equally uncomfortable, but investors should have done that as well. We get comfort from the consensus, but making the same investment choices as a large number of other intelligent people almost mathematically ensures you'll do the wrong thing at the wrong time, because security prices reflect that consensus. Staley Cates, Southeastern Asset Management. Wall Street sometimes gets confused between risk and uncertainty, and you can profit handsomely from that confusion. The low-risk, high-uncertainty situation gives us our most sought-after coin toss odds. Heads I win, tails I don't lose much. Monish Pabrai, Pabrai Funds. There are probably 5 main behavioral impediments that keep our industry from spotting and avoiding bubbles. First is basic over-optimism. Nobody gets married expecting to get divorced, a mindset that bedevils most of what we do. In our industry, that translates into this sort of innate bullish bias. Second, people suffer from an illusion of control that even if things do go wrong, they'll be able to sort them out. A lot of the modern risk management techniques created a totally false illusion of safety. The idea that by quantifying risk using a tool like VAR, value at risk, that you can therefore control it is one of the slightly more ridiculous things to have come along in years. Third, there's a self-serving bias in our industry. Generally, people make more money when markets go up than when they go down, so it's not often that people stand in the way. You can imagine a risk manager several years ago arguing against buying a pot of collateralized debt obligations. He would have been fired for obstructing a sterling opportunity. The next impediment would be myopia, a natural short-sightedness reminiscent of St. Augustine's plea, "Lord, make me chaste, but not yet." This is probably the most cynical of the biases because you often know what you're doing is wrong, but rationalize that you'll promise to be good after getting one more good bonus out of it. Finally, there's a change blindness or inattentional blindness. We just don't see what we're not looking for. We're governed by our recent experiences and don't actually ponder the bigger picture very often. Just because something hasn't happened in the past 12 months or 5 years doesn't mean it can't. James Montier, Société Générale. Humans have a strong desire to be part of a group. That desire makes us susceptible to fads, fashions, and idea contagions. Michael Mauboussin, Legg Mason Funds. People tend to suffer greater pain from losing a given amount of money than they experience pleasure from gaining the same amount, so the typical investor is a pain avoider who shuns stocks when there's any hint of trouble. That tendency results in a consistent overreaction to bad news that we believe creates investment opportunity. Daniel Bubis, Tetram Capital. When we find ourselves in trouble, when we find ourselves on the cusp of falling, our survival instinct and our fear can evoke lurching, reactive behavior, absolutely contrary to survival. The very moment when we need to take calm, deliberate action, we run the risk of doing the exact opposite and bringing about the very outcomes we fear. Jim Collins in How the Mighty Fall. There's a great chapter in Dan Ariely's Predictably Irrational about the ways in which we tend to misjudge price and use it as an indicator of something or other. That links back to my whole thesis that the most common error we as investors make is overpaying for the hope of growth. Dan did an experiment involving wine in which he told people, "Here's a $10 bottle of wine and here's a $90 bottle of wine. Please rate them and tell me which tastes better." Not surprisingly, nearly everyone thought the $90 wine tasted much better than the $10 wine. The only snag was that the $90 wine and the $10 wine were actually the same $10 wine. When they were tasted blind, without the signaling of the price, people came to exactly the right conclusion about which was the better wine. That, to me, was a tremendous example of the bias against value that people tend to have. James Montier, Société Générale. It is very hard to avoid recency bias, when what just happened inordinately informs your expectation of what will happen next. One of the best things I've read on that is The Icarus Syndrome by Peter Beinart. It's not about investing, but describes American hubris in foreign policy, in many cases resulting from doing what seemed to work in the previous 10 years, even if the setting has materially differed or conditions had changed. One big problem is that all the people who succeed in the recent past become the ones in charge going forward, and they think they have it all figured out based on what they did before. It's all quite natural, but can result in some really bad decisions if you don't constantly challenge your core beliefs. Jed Nussdorf, Soapstone Capital. One of the unfortunate lessons of speculative bubbles is that they always go on longer than we expect. It's what has caught me out more than anything over the years. I'm always too early. I usually see the bubble and talk about how I wouldn't touch this or that with a barge pole, but then watch painfully as it goes on for 2 or 3 more years. For professional investors, that can be a job killer. You can see how, in a world in which people are benchmark measured and totally obsessed with relative performance, career concern can be a driving force in all this. People are afraid of getting it wrong for 2 or 3 years, so they just go along, and the problem festers. James Montier, Société Générale. Humans have a tendency toward overconfidence, which may be reinforced by the stories that are prevalent at any given time, and by the fact that we tend to act on a biased information set to make decisions. The list of facts we retain in our consciousness very likely excludes other facts we either aren't observing or choose to ignore. That's a big reason people become overconfident, which plays a big role in bubbles forming. Robert Shiller, Yale University. In general, I believe markets are basically efficient, and that the academics are right when they say markets are even more efficient as market caps go up. The inefficiencies that haven't gone away, though, have to do with crowd mentality, when specific news or market events cause the crowd to rush in one direction. If you have the ability to think independently and to be patient, you can find opportunities when that happens. John Rogers, Ariel Investments. Investors overreact to the latest news, which has always been the case, but I think it's especially true today with the internet. Information spreads so quickly that decisions get made without particularly deep knowledge about the companies involved. People also overemphasize dramatic events, often without checking the facts. It's the classic, are more people killed each year by sharks or by being trampled by pigs type of situation. The dramatic event can get more play than it deserves. These types of overreactions are what we're trying to take advantage of. John Dorfman, Thunderstorm Capital. What the media should be criticized for is the cheerleader aspect of its coverage. Champagne corks would pop with every new 1,000 points on the Dow, as if that was the natural state of things, and that imagining that it could go down, or even rooting for it to go down, was un-American. It's gotten better when you start to see people like Warren Buffett show up on channels like CNBC, but I still find financial news as entertainment with someone like Jim Cramer sort of sad. Coverage of the market is always about making money, when in fact sometimes you should be worried about preserving your money. Since you don't get advance warning about what kind of environment is coming next, you should always be concerned about preserving your money. The person just watching cable TV might never know that. Seth Klarman, The Baupost Group. There is still a large and loud industry out there which on a daily basis tries to advise anyone listening exactly what they should do today, often right now, to be a better investor. For all but the smallest percentage of people involved in the market, that's bad for you, and it is not the way to build wealth over time. Chuck Akre, Akre Capital Management. March 2009 was a generational bottom, in my opinion, and it scared people to death. The market has doubled since then, but hedge fund net exposures are about where they were at the bottom. Institutional assets allocated to equities are barely above where they were at the bottom, and the public investor in equity mutual funds hasn't come back. There is a skepticism and even disdain for equities. They'll all be back. It may take a long time, but stocks will get overvalued again, and people will be buying on tips they hear at a cocktail party without spending a minute thinking about them. People are people, and will get greedy again. In the meantime, the negativity should be great for us. It gives us time to identify attractive businesses and buy them at discounts. Steve Morrow, New South Capital. I was always so impressed by John Templeton's enthusiasm, the fresh approach he seems always to take, and, of course, how independent a thinker he was. In 1939, right after Hitler marched into Poland, Templeton bought 100 shares of every stock on the big board, selling for less than $1. Within a few years, he had quadrupled his money. He always said the time to buy was at the point of maximum pessimism and pain, something we've all had experience with lately. John Dorfman, Thunderstorm Capital. It's a matter of time. Top value investors almost universally consider their longer-term investment horizons to be a competitive advantage. With investment decisions increasingly driven by short-term market, industry, or company concerns, the reasoning goes, individual share prices are more likely to misrepresent the future potential when industry dynamics are more normal, company misfires are corrected, or strong performance is more apt to be recognized. Most investment institutions define success as having a good result in each and every discrete time period. So it's quite logical that people in those institutions look to buy stocks that will do well from the current moment in time until, say, the end of the year. As a result, favorable occurrences such as positive earnings reports or value realization events that are highly probable but not likely to occur within the discrete time period are discounted at a fairly remarkable rate. If you traveled through time and brought back the Wall Street Journal from 4 years from now and could specifically identify the highest returning security between now and then, into which you should put all your money, people wouldn't do it. The uncertainty of not knowing the pattern of return, even given the certainty of the outcome, would keep people from buying it. Our opportunity is to take advantage of those kinds of inefficiencies. Murray Stahl, Horizon Asset Management. Time arbitrage just means exploiting the fact that most investors, institutional, individual, mutual funds, or hedge funds, tend to have very short-term time horizons, have rapid turnover, or are trying to exploit very short-term anomalies in the market. So the market looks extremely efficient in the short run. In an environment with massive short-term data overload and with people concerned about minute-to-minute performance, the inefficiencies are likely to be looking out beyond, say, 12 months. Bill Miller, Legg Mason Funds. The most important change in the business over the past 40 years is probably investors' time horizons. Today, the majority of investors, Ben Graham would call them speculators, are focused so closely on this week, this month, and this quarter. Did this company meet the estimates or did that one meet its guidance? Stocks are bought and sold on penny deviations from those estimates, which is mind-boggling. Crazy as it is, we can't complain. It just creates more opportunities for investors with longer time horizons. William Nasgovitz, Heartland Advisors. It's still true that the biggest players in the public markets, particularly mutual funds and hedge funds, are not good at taking short-term pain for long-term gain. The money's very quick to move if performance falls off over short periods of time. We don't worry about headline risk. Once we believe in an asset, we're buying more on any dips because we're focused on the end game 3 or 4 years out. Jeffrey Ubben, Value Act Capital. Music to my ears is when something is considered dead money and people say, "It looks okay, but I'll come back to it later when this or that issue resolves itself." That, to me, shouts, "Look here." Jeffrey Schwartz, Metropolitan Capital. One of the last great arbitrages left is to be long-term oriented when there is a large class of shareholders who have no tolerance for short-term setbacks. So it's interesting when stocks get beaten up because a company misses earnings or the market reacts to a short-term business development. It's crazy to me when someone says something is cheap but doesn't buy it because they think it won't go anywhere for the next 6 to 12 months. We have a pretty high tolerance for taking that pain if we see glory longer term. I actually think doing that is one of the few ways left to make an incremental return versus the market. Mario Sibeli, Marathon Partners. When I was starting out in the business, I was pitching a stock as a buy to an account in Boston. It was a conglomerate trading at 4 times earnings. My pitch was that it was really cheap and was going to go up a lot over the next couple of years. When I finished, the chief investment officer said, "That's a really compelling case, but we can't own that. You didn't tell me why it's going to outperform the market in the next 9 months." I said I didn't know if it was going to do that or not, but there was a very high probability that it would do well over the next 3 to 5 years. He said, "How long have you been in this business? There's a lot of performance pressure in this business, and performing 3 to 5 years down the road doesn't cut it. You won't be in the business then. Clients expect you to perform right now." So I said, "Let me ask you, how's your performance?" He said, "It's terrible. That's why we're under a lot of performance pressure." I said, "If you bought stocks like this 3 years ago, your performance would be good right now, and you'd be buying stocks like this to help your performance over the next 3 years." That's our approach. We buy today with an eye on performance several years out. I can think of only twice when what we did in the year that we did it helped that year. Bill Miller, Legg Mason Funds. Investors come up with all kinds of reasons to own or not to own stocks, and in times of stress, the reasons can become nonsensical because people get driven by this cascade of negative information. We see analyst reports all the time that say they don't like a stock short-term or they don't see a catalyst in the next 6 months, but that it's attractive long-term. Implicit in that notion is that I'm going to know exactly the right time to step in, and I'll let you know a few days before it's obvious to the rest of the market. Based on our experience and everything we've seen about people's ability to time the market, we don't understand how to make money on that basis. Will Brown, Tweedy Brown Company. With the frayed nerves of investors after the 2008 crisis, and with the continued rise of hedge funds, ETFs, and computerized trading, time frames have truncated. Our investment horizon is 3 years, give or take, which allows us to invest with no obvious catalyst other than mean reversion and a return to normalcy. That works when nobody is patient anymore. Sarah Ketterer, Causeway Capital. The average holding period on the New York Stock Exchange is 9 months or less, which I don't even consider investing. Over such a short period of time, you're just betting on the overall direction of the market or on the next quarterly earnings. Aaron Edelheit, Sabre Value Management. Many investors don't start with the question of whether General Electric or Procter & Gamble is undervalued. They start by trying to match the weighting in the benchmark. In 2001, when we were short GE, people thought we were crazy. How could you short the greatest company in the world with the best CEO in the world? I had no argument with that, but we were focused only on what it was worth and where it was trading, and concluded there was no chance it was worth $55 per share, which we said publicly at the time. The reason it traded there was because I'd estimate that 95% of the dollars invested in the U.S. stock market were either indexed or closet indexed. People had to own it to keep up with the benchmark. If they thought it was overvalued, their response would be to maybe buy only a 3% position rather than the 4% weighting the benchmark. That's the type of irrational behavior that can create inefficiency. Rick Dillon, Diamond Hill Investments. I would assert the biggest reason quality companies sell at discounts to intrinsic value is time horizon. Without short-term visibility, most investors don't have the conviction or courage to hold a stock that's facing some sort of challenge, either internally or externally generated. It seems kind of ridiculous, but what most people in the market miss is that intrinsic value is the sum of all future cash flows discounted back to the present. It's not just the next 6 months' earnings or the next year's earnings. To truly invest for the long term, you have to be able to withstand underperformance in the short term. And the fact of the matter is that most people can't. David Harrow, Harris Associates. Classic opportunities for us get back to time horizon. A company reports a bad quarter, which disappoints Wall Street with its 90-day focus, but that might be for explainable temporary reasons or even because the company is making very positive long-term investments in the business. Many times, that investment increases the likely value of the company 5 years from now, but disappoints people who want the stock up tomorrow. Mason Hawkins, Southeastern Asset Management. The human brain is incapable of conceptualizing something vastly different from what's happening today, but the big money ideas are those where the changes are far beyond what you can conceive today. The closer you can get to conceiving those types of changes and the higher the probability they might happen, the more likely you are to find big winners. Lisa Rapuano, Matador Capital Management. While we may not always be able to estimate it with great confidence, every stock has an intrinsic value that is independent of its current market price and tends to be far less volatile than the market price. That's because market prices partly reflect investor emotions, while intrinsic values reflect business fundamentals. Given that over sufficiently long periods of time market prices tend to revert to intrinsic values, we're simply looking to go long when the price is at a discount to a value we believe we can estimate, and to go short when it's at a premium to that value. What that typically means on the long side is that we're assuming things remain more or less normal or get back to normal when the implicit assumption reflected in the stock price is that things are going to fall off or never recover. Chris Welsh, Diamond Hill Investments. We have no problem buying things that take a long time to play out. Call me lazy, but I don't want to worry about last week's same-store sales or next week's oil price. Jeffrey Schwartz, Metropolitan Capital. We're trying to capitalize on the incremental mindset of Wall Street. IBM beats earnings by 10 cents in a quarter, and everyone cranks up their models and scurries around and takes their full-year estimate up by a total of 10 cents. We're trying to find companies where if Wall Street's EPS consensus is $1, $1.10, and $1.20 over the next 3 years, we're looking for something more like $1, $1.30, and $1.80, where we're seeing a material difference in the trajectory of the company's growth because of an expanding market opportunity, operating leverage, or capital redeployment opportunities that the Street is ignoring. In cases like that, you don't have to be precisely right. Approximately right can still make you a lot of money. Steve Morrow, New South Capital. Our thesis often is based on the passage of time. What makes a negative story negative may just be that the next 3 to 6 months, the time space in which Wall Street analysts live, don't look so great. We try to look at companies as a private investor would. To that investor, a company's near-term bad news is only instructive if it informs the long-term outlook. If it doesn't, why should we care? Robert Kleinschmidt, Tocqueville Asset Management. If you listen to earnings confidence calls, most of the questions are about what happened this quarter or what next quarter looks like. That focus would indicate that near-term